Little tear down, man.
I got the little circle with that sourdough. Right, make a little stuff pretzel thing, have your marathon on the side. It's like, and unfortunately, girls stick is that item number two, not play on these.
Got him right here.
$166, fixed there. In 142-835. Guess what? We got labor today. You all love snow? That they said, can we do something better? They said, yes, I'm gonna put. You can get them all that, Pringle or.
Goodness. Come on, brother.
Yeah. Or pepper.
Yeah, then you gonna get see you kind of finesse. But I ain't even go finesse that.
Like full flavor. That, yeah, that's my favorite. So I'm
That's it. Like I can't get a match. They make you pick these fucking. They make you pick these sections and shit, and you can't even get it. I know you know what I mean.
I got 3 points.
They're gonna start freaking down on that shit. I'm saying I do it all the time. What the fuck? I'm ready to use my black guy.
Welcome back to Market on Close. I'm Marley Caden. It's time now for Overlooked Stocks. Power systems company Cummins rallying to a new record today after a price target hike. Joining me now to discuss, George Tillis, senior markets correspondent here. Now, I'm looking at Cummins, and it looks like they have announced a new deal here, a partnership with Circle Energy to deliver natural gas-powered generators starting this year over the next couple of years here, George. So walk us through this and why this is so significant.
Well, I think it's significant. I mean, just look at what's going on with the company today. Cummins International as well as Caterpillar. I think both these names are hitting some new highs. So there's something of a tie-in between the two companies. And Cummins is one of these companies that is in the heavy machinery, construction, and transportation business. They're really right now a secular AI winner, especially when it comes down to what's going on with power generation needs. So the company's been a traditional diesel, natural gas, and now they're actually moving into electrified power systems. So they supply things like engines and turbines for generators, as well as electrified powertrain systems for heavy equipment, whether it's fleets for like buses, automobiles, heavy machinery, if you will, that use diesel technologies. And so the news today is, again, compelling because one of the things I've noticed is that companies that generate power on site, whether it's Generac, which is a generator company, or Cummins, which is one of their mainstay competitors. These companies have done extremely well as of late based on backup power needs for HPC or high performance computing. And so they secured a 2 gigawatt power deal with Circle Energy, as you mentioned, Marley. This is in West Texas to supply their technologies to high performance computing AI data centers in Texas. So this is helping anchor, the high performance computing build out in data centers in Texas, which is very large amongst many other states where we know data centers are becoming more prevalent and ubiquitous. But nonetheless, I think this industry space is typically cyclical in nature, but they're really, generating a lot of revenues and earnings on a secular basis because of the construction needs, equipment needs, not just for building data centers, but to help maintain them. And that's where essentially companies like Cummins International fit in.
It's so fascinating to watch the turnaround because, traditionally when I saw Cummins here, I thought, oh, they're like the diesel engines for railroads and trucks. But, this is their pivot, as you mentioned, into the AI boom. But as they pivot, they're actually sort of keeping themselves out of the bottleneck because you mentioned that on-site generation there, meaning that they're not relying on the public utility grids. Is the expectation here that we're going to see a lot more of these types of deals because we continue to have these conversations about the grids in some of these areas not being able to support this massive build out and that energy is going to be the bottleneck of infrastructure. But with this kind of play, you sidestep that.
Absolutely. If you think about the bottleneck transmission grid for electric power, there's a lot of red tape, regulatory, easement, if you will, needs. And there's a huge bottleneck there. So if you can bring what's prevalent in West Texas, which is natural gas, for all intents and purposes, a lot of natural gas just gets flared out or burned off through extraction of oil and other hydrocarbons. There's plenty of natural gas. So if you can pipe in natural gas to an on-site location and generate your own power, bypassing the electric grid, that's a huge win, both from an engineering standpoint, but also from an economic standpoint. And I think that's important in the context of what Cummins Technologies can provide, especially with on-site power generation that is very blended in terms of diesel. If there's diesel availability, they have that. Natural gas. Also, we're building out electrified power systems, including backup generation, backup storage as well. So they're balancing their technologies and markets have been growing. And this is a huge catalyst for the business, not to mention the heavy equipment side of building these data centers, which is also in high demand. And that's where companies like Eaton, if you will, have done extremely well, Caterpillar space. And the analysts, too, like Wells Fargo has the high street target now, 874. They continue to see these secular tailwinds for companies like Cummins to move forward based on the high CapEx build-out of AI data centers in the next few years.
Well, George, really appreciate you breaking down that one for us for Cummins and the response that we're seeing here to that deal. We are seeing the markets move lower in reaction to the FOMC and the press conference here, but Cummins holding on to its gains, still up 2 1/3%. Really appreciate it. That's George Tillis. We are close to the end of this market session. That means Alex Coffey will be joining us to break down the action we saw today, the reaction we're continuing to see from the Fed decision. That's all next on Market on Close.
Sometimes, you could have done better. The same goes for where you invest. Level up and invest smarter with Schwab.
Kick off the morning with the data and the decisions moving markets. Morning Trade Live breaks down the macro moves driving the price action, from Fed policy to global growth to inflation prints and geopolitical risk. Smart, fast, and always live from Wall Street to your screen. Morning Trade Live, where the markets meet the macro, weekdays at 10 a.m. Eastern on Schwab Network.
Hey, Bob.
Hey, Andrew.
Last year, I had a stroke. Big shock to see this person that I've always seen as support for the family vulnerable. That's Trump. Yes. Now we're in the car together almost daily. I started to realize when I picked up from my dad, been with Schwab for a long time. Jim, my man. I've probably been mad 20 years ago. Jim's really been there to answer any questions I ever have. It makes a huge difference when you have someone that actually cares.
I'm Kevin Green, and I track options flow daily, identifying who's buying, who's selling, and how it's going to impact the markets. Watch live on Schwab Network at schwabnetwork.com.
Trading at Schwab is powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals. You can spend less time searching and more time. I sense your fear.
I'm Kevin Green, and I track options flow daily, identifying who's buying, who's selling, and how it's going to impact the market. Watch live on Schwab Network at schwabnetwork.com.
I'm Alex Coffey.
And I'm Jenny Horn. This is Next Gen Investing. We track the trends shaping tomorrow's market.
From tech to energy, crypto to consumer, we focus on what's driving investor sentiment right now.
Clear analysis and forward-looking market coverage every trading day.
This is a make-or-break level for this stock. And that could certainly be a short to near-term catalyst.
Next Gen Investing, 1 p.m. Eastern.
Only on Schwab Network.
Sometimes, you know, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Trading at Schwab is powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live coverage and access support by phone, email, and in cloud.
We've got red across the board here in the aftermath of the FOMC interest rate decision, which was to leave rates unchanged. The S&P now trading down 1.2% lower at 74.20 to close out the day. The Nasdaq down almost exactly 1% at 29,760. The Dow ended the day almost 1% lower as well, 51,493, and the Russell 2K closing out the day 0.75% lower at 29.18. We did see a bit more of a mixed picture right after the decision came down, but then we saw the markets really start to plummet. It also took all of our sectors along with it. We saw all 11 sectors close out in the red here. Technology down by 0.33%. Communication services a big laggard today, down 2.75%. Consumer discretionary down 2.5%. Consumer staples down 2.25%. As we keep spanning here, we're going to go into more red. Utilities down 1% and a third. Real estate also a major laggard at 2.5%. Industrials here down more than 0.1%. Materials down 1% and a third. Don Kaufman said earlier on Trading 360 to watch real estate for volatility, and he was correct there. Financials down 0.5% here. Energy down 1.25%, and healthcare down about 1.5%. As we saw things entirely red. And let's just keep this red train going here because we've got mega cap tech entirely in the red as well. Apple down 1%. Amazon closing out the day 3.5% lower. Alphabet down 2.5%. Microsoft down almost 4%. Meta down more than 5%. And Nvidia closing out the day 1% and a third lower. Lots of red there. Alex, I often make jokes that when I wear red, the markets turn red, and somehow I did it again. So I'd probably just need to take red out of my wardrobe. But let's talk about this market action and where we closed, because when we spoke at the beginning of the show, we had a mixed picture in terms of what we we're seeing from our major averages. And then we saw, once the press conference ended, not a sharp decline, but a pretty swift move to the downside across the board.
Yeah, every sector lower. In terms of the areas of weakness that were most pronounced, there were the areas of weakness that were most pronounced for much of the day, and then joined the party. So communication services, discretionary healthcare, throughout much of the day were weak. IT swung negative, and it closing down provided 17 points worth of downside to the S&P 500, third biggest contributor after consumer discretionary and communication services, which really means Mag 7 names were a big drag. And as an index, the Mag 7 index was down almost 3%. So it's a really tough current to swim against for the overall market. Overall breadth was about as weak as we have seen in quite some time. For the first time, really since April, I would say you had a macro day today, where it wasn't a reshuffling of a portfolio to maybe take away some idiosyncratic risks of overconcentration or expression on that front, aka move out of infotech into something else or move out of AI into something else. Today was kind of an indiscriminate selling of many different parts of the market, and only 14% of stocks in the S&P 500 actually closed higher. But to me, this isn't where the story really lied. And where the story lied was within, unfortunately, not the most interesting of topics, but the Treasury yield complex. And to me, it's a very straightforward reaction. And what you saw was a dramatic flattening of the yield curve. So you saw two-year treasuries, which are oftentimes seen as the most sensitive to anticipation of what the Fed may or may not do next, move up 16 basis points to 4.2%. But if you went up to the 30-year, you actually saw the 30-year come in almost 2 basis points, and they're sitting around 4.92. So net, the biggest curve that is often cited is that 10-2s curve. Well, the 10-2s curve came in 11 basis points, near over 10 basis points. That's a big move. And so what is the market saying? The market is saying, we believe that the Fed may do something in the interim to deal with inflation. Because what they're saying is the most sensitive, and what that thing would be move rates higher, because the rate sensitive part of the market that is so tied to the Fed, two-year treasuries notably, moved up 16 basis points. That's dramatic. And then when you look at the stuff that's farther out, a little bit more detached from Fed, but more associated with economic growth and inflation, it stayed the same or actually came in, which says that there's a belief that the Fed is serious and will do what they say that they're setting out to do, but also that might stifle growth a little bit. And so in a long about way, you may actually see kind of, I don't know if a stimulative impact ultimately would happen from this, but if this was the reaction, it's saying you could actually see mortgage rates come down. And the reason I say that is the flattening of the yield curve is more of a reflection of economic concern and inflation being stifled. Had something else happen where they came out and they were very dovish and you saw short-term rates come down, you might have seen the equity rates spike, but you might have seen a dramatic move higher in 10s and 30s because the thought would be, oh, more inflation is here to stay, it's going to become more entrenched. Sure, there might be more growth, but at what cost? So you had almost a deflationary shockwave through the market today, and I say that word intentionally, and deflation means risk assets come in, and that's always the I think misnomers. We talk about inflation as a risk, and it is, and it impacts us at the grocery store and the gas pump, but when it comes to risk assets, the reason the goal is 2% and not 0 is some inflation is good for growth and indicative of a growing economy. If it goes the other way and you stifle it altogether, you have deflationary. That was 2008, 2009. So today isn't moving us to 2008 and 2009, but it had that type of an impact where you had a deflationary wave hit this market maybe for the first time this year, and that's not a bad thing given what has happened over the last several months, which is dramatic inflationary growth, particularly in AI.
And Alex, too, as we look at the reaction, I mean, nothing changed. sequentially from when we spoke at the top of the show while Kevin Warsh was still continuing the Q&A portion of the press conference. But as I was watching the big board, we saw a pretty swift reaction once it ended. And so I was trying to refresh the wire to make sure we hadn't missed something while we were on air here, and nothing really changed. So why do you think we saw this seesawing as everything was being announced in real time? And then when there was no consequential change, we then saw the reaction. I mean, and the market's clearly pricing in a hike by October.
I think, well, first off, the bond reaction and the hike odds changing is why you see the marketplace reacting ultimately how it has in terms of settling lower. But I think the reason that there was a back and forth was there was kind of this, I think there was probably a feeling among some of the participants like, well, when are we going to get that if? Or when are we going to get that, like, but I think we're probably going to see lower rates or some sort of an asterisk. And the asterisk never came. And so when the press conference concludes and you never kind of get that bailout statement, eventually it's like this, kind of a, the water kind of breaks through and you start taking on a little bit of water onto the boat. And so, look, I think this is healthy price action. I think this is in line with the sentiment that we got. And so if your goal is, and your Kevin Warsh's goal is to say what he said today, this in many ways I think is what you would have wanted to see. It's congruent with what was kind of said and I believe interpreted from the market. All that to be said, how does this jive with what was thought about this particular person and what the Fed was going to look like going in? And I think it can. And the reason I say that is one of the things we talked about earlier that he laid out was this sort of 5-part task force series about ways to, I use this phrase, modernize the Fed. I think that characterizes it well. You can't make sweeping changes in a credible way if you don't accomplish what you set out to do first. So if I'm Kevin Warsh and I want to make these changes, my first goal is get the situation under control using the old framework so I don't just destroy my credibility or confuse things before I even want to make changes so that I actually can. And so, look, he might be a little bit more dovish in terms of his lean. He may want to, really make ginormous reforms, but to do so in a credible, lasting way, he needs to solve the problem first, or at least get it into a place where it's felt that, hey, things are on track so we can comfortably make these changes. And I think that was the goal today.
And Alex, I want to touch on one of the positives. You said, I think we only saw about 14% of companies close in the green. One of those companies was Intel, and it was pretty significantly in the green, even with this pullback that we saw before the close, on some very interesting and potentially huge developments for the company.
Yeah, so what I kind of framed this as, we talked about these details more in depth earlier, but essentially they're going through a process to test a really advanced version of their chip process, and it's a critical step towards ultimately doing this at a mass scale, and it's kind of seen as a critical step towards getting big customers like an Apple or Google in the door. And if we kind of zoom out and we look at Intel over the last decade, 9 of those 10 years has been Intel saying they were making these changes, it's going to take a little bit of time, and the market not believing it, and the stock price eroding. And then last year, they get a inflow of capital from the U.S. government, sort of a investment in terms of national security, but also, in many ways, I think it was a show of confidence seen in Intel that the U.S. government was going to be there to help them in this sort of time of need. And you saw the market change from doubting Intel to believing in Intel. But you fast forward this last year, still nothing really had changed. They still haven't signed up any of these publicly major external foundry clients. Some chatter that Google maybe has had some pretty advanced talks. Apple may be interested, NVIDIA, a lot of these names. But nothing really externally public about this. Yet the stock is like 5x off of its lows. And for that all to be true, at some point these turnaround plans have to actually happen. And I think today was a meaningful step. They are not there. There was a ton of challenges still for the company. But for the first time in a long time, it's not just belief in the words, but maybe actions and meaningful progress that they can show that they're making, a couple steps down the path.
One of those gainers on the day for Intel, closing 3.5% higher at 121.10. Alex, really appreciate your continued breakdown of the reaction to the Fed announcement here, and also for a quick look at one of our customers today in Intel. That's Alex Coffey, our senior equities contributor. Coming up, we are going to discuss a hidden bottleneck bottleneck in the AI build-out that many might be missing and could be the next investment opportunity in AI infrastructure. Market on Close. We'll be right back.
I'm Kevin Green. I track options flow daily, identifying who's buying, who's selling, how it's going to impact the market. Watch live on Schwab Network, schwabnetwork.com.
From the most iconic trading floor in the world, this is Opening Bell with Nicole Petalides, live on the floor of the New York Stock Exchange. The countdown, the setups, the stories that make markets move. Minute-by-minute breakdown of the biggest headlines, earnings, and global movers. Just the trades that matter. As the bell hits and the markets react in real time, Opening Bell, live at the NYSE, right when it counts.
Trading at Schwab is powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email,
And I'm Jenny Moore. This is
From tech to energy, crypto to consumers, we focus on what's driving investor sentiment right now.
clear analysis and forward-looking market coverage every trading day.
This is a make-or-break level for the stock. And that could certainly be a short to near-term catalyst.
Next Gen Investing, 1 p.m. Eastern.
Only on Schwab Network.
Sometimes, you know, same goes for where to invest.
Welcome back to Market on Close. I'm Marley Caden here in our Chicago headquarters. To discuss a hidden bottleneck in the AI build-out that many may be missing, let's welcome in our next guest. Joining us, James Kerr, CFO of Filecoin. James, great to have you on the show, and thanks for joining us from the floor of the NYSE today. Now, as we look at this, a lot of the conversation when we're talking about bottlenecks are potential chip shortages, energy issues, but you are highlighting something different. You're arguing that the real bottleneck here is something called data gravity. So explain for our viewers what you mean by that.
Yeah, sure. So thanks so much for having me. First of all, it's a pleasure to be here. And yeah, some top analysts are saying that we're only 10 or 15% into this AI build out globally. And I think the market's starting to just wake up to the fact that on the data layer, we're actually even earlier than that. Data is incredibly important for the AI era that we're entering right now. In the very recent past, we haven't really had very much use for storing all the data that the world creates because no one could look at it. People couldn't look at it, computers couldn't look at it. But now with AI, there's lots of reasons to have data and for us to collect data and store data and use that across businesses, across AI labs and models. There's actually an insatiable demand for data. And we're just not ready for that worldwide. Storage is a huge limiter, a huge bottleneck. If you look at what a lot of the names in storage that are listed on the stock market are saying in their reports, their quarterly reports, there's actually a real bottleneck on the factory producer devices with multi-year waits to get the hard drives that they need. So this is something that I think people are just waking up to now, but we need to have solutions for these problems.
And James, why is the moving of data becoming such a critical challenge here? Because if you have GPUs and you have power, why can't you simply move the data to where the compute is?
Right, so the compute is increasingly being built where there's power. So historically, compute was built in places where there were people, and now increasingly it's a matter of where the power is available, where it's abundant, and where you can have the space to build the GPU clusters. So what we've actually found in our research is that 1/3 of the GPU clusters that are being built right now are being built in what we're calling data deserts. They're more than 500 kilometers away from the nearest storage infrastructure, and that's actually a huge increase from the percentage that are being built in those locations from just a couple of years ago. and that trend's going to continue. So the data infrastructure is not where the GPU clusters are, and the operators on the Filecoin network, they're a lot more nimble, and so they're actually going and taking advantage of that opportunity because they can move their operations and they can spin up operations much closer to where the GPUs are. So this is a big opportunity for the operators that we have on the Filecoin network.
And for people trying to understand what we're talking about here, because I think when we think about the data and the data centers and the physical part of all of it, we're not talking about the physical part here. Is there an analogy here to a previous technology cycle where investors initially focused on one layer of the stack, but ultimately the value accrued elsewhere that you think could be applied here?
Yeah, I mean, I think it's actually the entire stack. It's really just about the weight of the story. The story's been about GPUs for the most part.
Then I did Secure Investigation.
Memory, but hard drives
and I did the boots.
Storage, the sort of permanent storage that we need for this build out and to take advantage of.
I did this. I did the Titanic Hydra.
And the world writ large is actually.
And then I did Trinity for it.
By storage. So it's a whole stack, and what we're seeing from everybody that we talk to in the market, there's just an insatiable, almost price-insensitive demand for this kind of storage. When you look at robotics and self-driving cars and businesses that are deploying AI in all of their business processes and on factory floors and throughout all the different parts of their organization, this is just a huge amount of data that has never really been needed before, has never been usable before. And so it's both capturing the data for AI training, and all of the frontier labs are looking for this data. They have a huge amount of demand for it, but also for organizations, businesses that are deploying AI deep in their workflows, they need their data lakes available, and they need it available in highly performant ways, which means having it close to where the GPUs are for both training the models and also for inference. So this is a story that's actually going to become, I think, much, much bigger, because for us to realize the full potential for AI in business and actually just in life, as we think about everything that AI can do, data is going to increasingly become one of the big bottlenecks, and we have to have the infrastructure available to actually do it. So it's the whole stack, and the part that's underappreciated is the storage layer.
And how much of a cost issue is this, James? Because like I saw, for example, CoreWeave is covering up to $1 million in data migration costs for customers. But if cloud providers are charging significant fees to move this data, I mean, how much does that fundamentally change the economics of AI deployment?
Absolutely. I mean, there is a sort of an in the industry egresses have been a huge issue, so this is a little bit of a term of art, but the hyperscalers typically have charged a pretty big tax to take your data out and to be able to use it other places. The industry is grappling with this right now because the GPUs are just not available from all the time where you want them to be. You need to have your data transportable and sort of sovereign, because if you don't have it sovereign, you can't move it to where the GPUs are. So if a cluster is not available that you usually use, you want to move it to another cluster, and we're, you know, the whole industry is grappling with that. At Filecoin, our operators across the network, the way that they're grappling with some of these cost issues, because it's also on the hardware side too, is they're making really good use of the infrastructure that already exists. So Filecoin is the biggest sort of decentralized and distributed network of our type anywhere in the world. We have a huge amount of build-out that's happened over the last few years. Our operators have invested a ton in hard drive and all the networking infrastructure that's required, and getting that sort of in the places that it needs to be is something that our operators are kind of uniquely capable of doing. Whereas some of the bigger players out there, the incumbents, the hyperscalers, they have a hard time moving their data centers because they're huge multi-billion-dollar projects that they took years to construct. So the nimbleness is a huge factor, and you know, there's a lot of people that are looking for solutions to this, but a lot of the operators on our network are specifically going out and capturing that opportunity.
And so, James, as we look at this in the perspective of the broader build-out here, could these infrastructure constraints, I guess for lack of a better word here, ultimately slow overall AI adoption, or are they simply going to shift where we're seeing some of this CapEx spend going?
Yes, definitely. I think that this is definitely going to be something that holds companies back. And something I didn't mention previously is that if you're in the AI space, or even if you're just a business who's focused on becoming more AI native or building AI into your workflows, whether you're a small business or a large business, being able to actually train your models and get AI deployed inside your organization is something that takes a lot of time and a lot of energy. often depends on a lot of data. And having your data physically close to your infrastructure, your GPU infrastructure, your compute infrastructure is actually a huge competitive issue for those kinds of people that are doing those kinds of things. It's not just about the taxes that we talked about. It's not just about like the cost of your storage bill. It's also how quickly can you draw on your data lakes to train your model. And is someone else, one of your competitors, drawing on their data lakes more quickly and being able to be more nimble to refine their models and train their models. So this goes really deep. And to your point, I think this is going to become something that a lot of businesses and a lot of participants in the industry are really focused on, because it's going to be the next big bottleneck.
Okay, lucky flip, good
But also
job.
like having the data where it needs to be when it needs to be there, and making sure that performance is there.
Really appreciate you being with us to highlight this potential bottleneck that we aren't talking much about for data gravity here. That's James Kerr, CFO of Filecoin. Coming up next, we are going to close out the show with my final takeaways and also what I'm watching for tomorrow. Market on Close will be right back.
For instant reactions, earnings breakdowns, and hot takes that teach you about stocks and markets.
You are
Follow me on X.
He is the dirtiest mind.
And connect with me, Nicole Catalidis, on LinkedIn,
Let's
Facebook,
look at
and
let's go watch the
Instagram.
replay for who started this whole thing. Who started this whole
This
thing?
is Fast
Got me in
Market.
trouble
Local
with
traders
Blondie.
want more than just headlines.
We walk you through trade ideas with
Okay,
structure,
so we do have a peel
risk
here.
management,
I see.
and a focus on execution.
Options, chart earnings,
here.
the volatility plays. We bring decades of trading experience.
With real-time insight across products
just been
and
giving up on-
sectors, we
Oh, by
deliver
the
what
way, I just saw
active traders
something,
need
guys,
to stay
reminder.
ahead.
We're a
Fast
week
Market weekdays
and
at
a
noon
half
Eastern, live on Schwab
From the
Network
Mount
at
Whitney climb.
schwabnetwork.com.
From the Mount Whitney climb.
Stay connected to what
I'm
moves
gonna
the
have to go
market.
to corporate
Download the
sponsors,
Schwab
guys.
Network
But
app
I
and
really am
stream
trying to raise the money.
anytime
We're trying to raise
wherever you are.
$3,000. We have about $2,500 left to go. It's on June 27th.
Welcome back to Market on Close. I'm Marla Kaden. Here's some final thoughts on the session. We saw our bull market broaden out again today. Financials trying to draw some focus as we saw the KBW Bank ETF hit a fresh all-time high. Sure, the JP Morgan, Bank of America, Goldman Sachs, and Morgan Stanley all touched new intraday records, while Citigroup climbed to its highest level in years. Investors are increasingly betting that a combination of resilient economic growth, improving capital markets activity, and a more stable geopolitical backdrop could support stronger earnings for the banking sector. We did, however, see the overall sector close down about 0.5% following the FOMC decision. And CarMax shares fell roughly 9% today after reporting earnings and revenue that topped Wall Street expectations. Earnings came in at $1.31, that handily beat forecasts that investors were looking for, but they were focused instead on margin pressure, on weaker profitability versus a year ago, and also on management's comments about ongoing operational challenges and the need for cost reductions. The stock had rallied more than 30% over the past month heading into this report. It had a very high bar set for the results. We also saw shares of rival Carvana moving lower today as investors reassessed the outlook for the used car market. And we got an update to a story that we discussed yesterday. Lionsgate Studio dropping more than 6% after Netflix publicly denied reports that it was pursuing an acquisition of the studio. The move did erase part of Tuesday's nearly 14% rally, which had been fueled by speculation that Netflix could emerge as a buyer amid ongoing media industry consolidation. Netflix shares also slipped as investors digested the company's denial and the latest reminder that takeover rumors can move media stocks sharply even when no formal deal discussions are underway. And last but certainly not least, as we've been discussing throughout the show, the Federal Reserve left rates unchanged today in Kevin Warsh's first meeting at the helm. Heading into tomorrow, I'll be watching for continued reaction to that decision and the press conference. Warsh experienced the worst Fed day reaction in S&P names for a new chair since 1994. We saw all of our major indices fall entirely into the red before the close. We also saw a dramatic flattening of the yield curve. The 2-year moved up 16 basis points to 4.2. The 10-year jumping more than 6 basis points to 4.49, and the 30-year came in almost 2 basis points. Alex Coffey called it a, quote, almost deflationary shock wave that moved through the markets. So seeing where the markets open tomorrow will certainly be of interest to me. We'll also be getting initial jobless claims, which are expected to be down from last week. And we'll have earnings from Accenture future. The street is expecting EPS of $3.70 on $18.82 billion. That would be about 6% growth year over year. Also, a reminder, it's the last day of trading for the week as we have the Juneteenth holiday on Friday and the markets are closed. That is going to do it for us today on Market on Close. Thank you so much for joining us. I'm Marley Caden. You can download the Schwab Network app available in the Apple App Store, and you can tune in 24/7 on SchwabNetwork.com. I hope you have a great rest of your Wednesday.
Okay. There we go, guys. So that's all good. Let's go and look at. I haven't mounted this in a while. I think the mounting for this actually takes a little while, so it's
where
good to actually do
real-time
this
market
beforehand.
coverage meets expert strategy.
I'm going to make sure I open this and leave it open.
To the closing bell, we've got you covered.
Tandem skydiving. I was supposed to do that for Maddie's graduation. My point is that they're getting a higher rate of change in sales based on the guidance. And they decided to give money to
Follow the biggest headlines, live analysis, sharp trade ideas, minute by minute.
to pay for Madeline to do tandem skydiving. She needs something to go
with speed, accuracy,
I think one of the most important things is making a play in a risk-defined way here going into earnings.
So that would be a
my wife has done it, and she would like me to do it. But as a former Air Force guy, though I never actually got to fully go in, I find there's an issue with jumping out of
Schwab Network, streaming 24/7, anytime, anywhere, free. SchwabNetwork.com.
actually look at the book here.
Your team has Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you. With unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your Investor Checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. They're like cash moves is in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Okay, so here we go. We're opening it up.
Frozen to the next like
Find out how more about the product. I just want to install. I'm going to do 84 AM5.
Good afternoon and welcome to the Watch West. I'm Sam Barter sitting in for Nicole, ladies. It is 2 p.m. here in New York.
So it says take out the screw.
We will have wall-to-wall coverage of the FOMC announcement and Kevin Warren's first Fed chair at the bottom of the hour. But for now, let's take a look at where the markets are trading with just 2 hours left in the day right now as we get this decision. We have got a pretty flat performance for the S&P 500. Looking for some direction from what we're getting from the FOMC this afternoon. Here the Dow Jones has hit another record high, extending on the gains we saw yesterday, up a quarter of 1% right now, putting on almost 100 points. We're off the highs right now, but the Russell 2000 up 1%. The Nasdaq 100, the tech trade back in rally mode today, pulling ahead to the tune of 0.3%. Let's take a look at these futures products as this decision is imminent now. We have, of course, had yields and oil backing off. We've got the dollar index firmer right now at 99.
Just because I prefer not to
at the moment. Gold futures are pointing upwards to 0.4%.
I get it, right? It does save paper, so it's not necessarily a bad thing.
Bitcoin is lower on the day. All right, let's bring in Tom White, co-host of Fast Market here on the Schwab Network. It seems like no surprises here, keeping this rate unchanged here. Keep us up to date with what you're seeing, Tom, and the market reaction.
Yeah, market a little bit weaker here
like the stream over YouTube.
Something unexpected at this point, right? I think everything needs to be focused on Kevin Warsh and his pressure that starts in about a half an hour here. But one item of note, 9 out of the 18 FOMC participants pencil in a rate hike for 2026. Now, we all know what their projections mean.
Did I say job title?
Those typically go away relatively quickly, and maybe that's why
$250 on your first campaign and get a free $250 credit for the next one. Get started at LinkedIn.com.
Less transparency might be better, and maybe getting rid of the dot plots might be something better that they have to look at. They lowered their median 2026 GDP projection to 2.2% from 2.4% previously. And then if you look at the next 2 years as far as the Fed median rate forecast, 3.375%. The forecast was for 3.125%, and that was the previous level also. So we're seeing a little bit of weakness here. Looking at the 10-year yield here, 4.46. They ticked up about 2 bips.
Like so.
So not much movement there. So that's the thing. One of the reactions initially that I saw that they removed one of the statements from the previous Fed release. Power at this point. So I think you're going to have to take this with a grain of salt. I think the press conference, typically those have gone pretty muted, right? Softball questions for Fed Chair Powell. I think the opposite is going to happen today here, Sam, where I think he's going to get some hardball questions because he's been critical of the Fed. Kevin Warsh has repeatedly over the last decade, and they're going to want to know what his outlook is for inflation, for the jobs market, for maybe giving up some of that transparency and guidance that the Fed had instilled under Fed Chair Powell. So there's going to be a lot of questions to answer here when this press conference starts in about 25 minutes.
Absolutely. I mean, obviously those who knew him as the Federal Reserve knew he was an inflation hawk, and then that's really obviously been the big focus because he was seemingly a little bit more dovish, you could say, within that process of interviewing with President Trump. And so the big question this afternoon is, who is the real Kevin Warsh here? And will he bend to political pressure? I think that's been a really big question around, obviously the independence of the Fed. But there are so many other burning questions, as you say. I mean, does he submit his dot? Is there being more guidance? Does he say anything about shrinking the balance sheet? I mean, how does he actually see the economy right now? Interesting because we continue to see the data coming in. I mean, the retail sales this morning, they continue to point to this economic resiliency. I mean, particularly with the consumer, obviously some would view inflation as a problem that's been a problem for 5 years that predates the Iran war, and so you might have this sort of temporary
I'll use Noctua, Joshua.
Supply shock right now, but you also have from all the AI investments this idea that you have this sort of positive demand shock also feeding into the inflation picture as well. What is it that you're looking out for as far as some of the language here? Because you raised a really interesting point. I mean, is this going to be a case where he's the new kid on the block, he doesn't want to shake the boat too much, he sort of comes out and he acts very balanced, or does he really make his mark and put his stamp on it, given everything you just said about his criticism of the Fed leading into this time?
Yeah, and I think you make a good point because he wants to set a new tone. He stated this before that there needs to be changes made. Maybe some of the models need to be a little bit different. They removed a whole paragraph from what I was just kind of glancing down at from the previous Fed statement. So, yeah, he's going to have to put his stamp on where he thinks expectations are going to be. You mentioned, retail sales have been pretty robust. Earnings have been blowout, Sam, and that's what supported this risk-on aspect into the equity market at this point. And now we've got crude oil that's falling with the potential deals being signed this week. So what does that do to inflationary pressures that have been going the wrong way? They've been going higher. And how does he balance the two Fed mandates between, robust jobs market at this point and inflation rising, but most likely to start to come down relatively quickly at this point? I think you're going to see a real big bifurcation in some of the commentary from the Fed after this meeting and after Fed Chair Warsh speaks today, is that you're going to see more division. Maybe that's a good thing because he stated before, going into these meetings, argument or holiday fight when you bring up topics maybe you typically talk about, and maybe that's good for the Fed moving forward.
Absolutely. I mean, and people will say Kevin Warsh walked into a very divided Fed yesterday. around. And as you say, he wants to see family fights. You said that explicitly, and so obviously he wants to see healthy debate around this economy. So obviously we'll be taking that press conference at the end of the hour, listening to what he has to say in his first press conference as the Fed chair. Tom White, really appreciate it. Thanks so much for the reactions. Now let's take a look at the bigger picture with Jeffrey Cleveland, Managing Director, Chief Economist at Payton Regal. Jeffrey, thank you so much for your time. What did you make of the decision and some of the comments we're getting out? I mean, it's obviously a unanimous vote here. Convenient timing with oil coming off and yields giving them a little bit of relief here. Just walk us through your initial thoughts.
We had a rear fan in yesterday's bill.
Well, initial thought, first and foremost, that FOMC statement, I guess brevity is clarity. It's a much shorter statement than we're accustomed to in the past. The last sentence of the statement with the committee promising price stability being the key takeaway. So maybe that's more of what we could expect ahead. Less is more. Less information coming out, but more clarity, more to the point. We'll have to see. I thought it was interesting that 9 of the 18 folks that submitted dots, we're missing 1 dot. Should have 19 dots if my math is correct. We only got 18, so but be that as it may, half of them saw a rate hike in 2026 so that's quite interesting. I would say we have a ways to go in a year. It's quite possible we have continued economic growth, as you pointed out, a stable unemployment rate, and then I think it's possible at some point later this year core inflation starts to cool, and then to me that's a Fed on hold, not necessarily hiking, but obviously the committee has differing views, and there'll be good discussions at subsequent FOMC meetings.
Yeah, I mean, if this is a data-dependent Fed, I mean, how would you be characterizing the numbers that we've been getting? I mean, I obviously mentioned the retail sales out this morning. We've seen the Atlanta GDP tracking at 3%. That was revised again today. You know, this is a strong economy, it looks like. I mean, it is showing signs of resilience. And so how do you think that is likely to feed into the calculus?
Yeah, I mean, resiliency. So we have a resilient economy.
More of it,
We've had, last year we had the tariff shock. This year we had the Middle East and oil shock, and still the economy continues to grow. Obviously, we're getting a nice tailwind from tech. The U.S. is a beneficiary of that story. So the second big point, stable unemployment rate, despite softer hiring trends in the last 18 months. The unemployment rate still around 4.3%, and the FOMC expects it will stay there, throughout the year. So that's great.
Yeah, so I'm excited to see how those perform.
Inflation. Now, I think we could debate how bad the inflation story is. I mean, we're above target, but on core PCE we're about 3.3 relative to a 2% target. I'm going to be keen to hear what the new Fed chair says for does he mention an alternative measure of core inflation, which is the Dallas Fed's trend measure of inflation, which is up 2.3% in the last 12 months. So it shows a little bit less of an inflation concern. So it will be interesting to see how he frames that. Altogether, though, I think this is a situation where the Fed can just be on hold.
If I'm not mistaken,
they don't need to cut. They don't need to hike. Just wait and see how things play out. If you have a resilient economy and inflation does eventually cool,
and I'm excited to see how
the
Panther Lake
then that would be a great story. And you don't need to stamp out the hiring. You don't need to push the unemployment rate higher.
Supposed to get one. I'm excited to see how
those. Right. I mean, there seems to be a view that the Fed is likely to try to avoid having to hike and sort of sit on its hands throughout the rest of the year. But I mean, the data could very much change that course of action. Obviously putting more pressure on the Fed to have to reconsider what happens. But what flips the script, do you think, to consider then once again rate cuts?
But we'll see how it goes.
Okay, I would say you have risk in both directions. It would be an unemployment rate that starts to rise. Again, we saw that in 2024. The unemployment rate moved up 30, 40 basis points, so 0.3, 0.4 percentage points, and then the Fed was cutting rates. So I think that's really a key metric that could bring things back into the cutting frame. On the other side, what would drive hikes? What would really build the case? So not just 9 of 18 18, but 15 of 18 or something. I think wage growth needs to reaccelerate. So far, even though the economy has been resilient, wage growth has been pretty tame. Average hourly earnings have been cooling. So I just don't see this overheated economy, this overheated labor market where the Fed would need a hike. But that could change as well. So I think you have risks to both higher and lower rates from here.
We're about 20 minutes away from Kevin Warsh taking the stage and the microphone for the very first time at the Fed as the chair. What changes are you expecting?
Yeah, they're in
Do you
YouTube chat,
believe he comes in all guns blazing, tries to really make his mark and put a stamp on his first press conference here? Or does he take a sort of more measured, balanced approach?
$300.
Well, I have to tell you, I've never been a fan of these stock forms. So I think they issue these dots, these projections, where they think interest rates will be this year, next year, in the long run. And then what happens at every press conference is the assembled media, the press says, hey, well, the dots say this, and then the Fed chair always says, oh, but the dots are just a collection of just whatever we thought at the time of the meeting. They're not a policy, communication tool. So then I'm always left with, why do we have these dots then if they're not serving some purpose? So I can see him moving away from that. I'm not a big fan. I can see also, do we need 8 press conferences a year? We're going to decide this deal. As a Fed watcher, and I'm sure you're as well, we like not necessarily new information. We can tell stories, we can talk to clients about it. But does it really help monetary policy? You'll recall just less than 10 years ago when Powell came in as Fed chair, we only had 4 press conferences per year, and Powell chose to go to 8. Could we go back to something more like a quarterly press conference? Would that be so bad? I don't know. So something along those lines. And then, as I mentioned, I want to see, if he's going to point to alternative measures that investors, that policymakers should start to look at or look closer at. And I think the trim mean inflation measure is one I'd like to hear his stance on that. He did mention that, I believe, in his recent congressional testimony.
Yeah, I think that is some of the expectation. It's just how much appetite there is to obviously shift to looking at that as sort of the guidance here. But really appreciate the instant analysis. Jeffrey Cleveland, Managing Director, Chief Economist, Peyton Regal. And just want to mark these markets very quickly because we've had the dollar strengthening. We're at 100 now. We've got stocks selling off now. We have turned into the red. Coming up next, and at 2:30, we will bring you Kevin Warsh's press conference live. Please stay with us here on Schwab Network.
And we're just going to have like a couple of
Damien just got back from vacation, so he's in a very good mood. He went on an Alaskan Disney cruise with his wife. Intern. And he is in a nice and relaxed mood. Brian's got a vacation Me? I don't take vacation.
everything investors need. All we need is come together. Yeah, Schwab, you can do everything. Invest, trade, get full service wealth management.
Everything goes well. Unless everything in Robotech falls apart. Then I'm not going anywhere.
We have to buy
but it should. These are both right angle. Okay, here we go.
Invest your way with Schwab.
Sometimes, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
I'm Jenny Horn. We go beyond the headlines, tracking the trends, sector moves, and fundamentals shaping the markets in real time. This is Schwab Network. Subscribe at schwabnetwork.com.
Really clean looking.
Stay connected to the markets with Schwab Network.
Tune in 24 hours a day, 7 days a week on schwabnetwork.com.
And on all your favorite streaming services.
Stroke? Yes. Now we're in the car together almost daily. I started to realize, what can I pick up for my dad? He's been with Schwab for a long time.
Jim, my financial consultant. I programmed
20 years ago. Jim's really been there to answer any questions I ever have. Makes a huge difference when you have someone that actually cares.
Your inhibitor has been destroyed.
I'm just going to answer and say I'm streaming.
I'm Alex.
Hi, you're live with Robotech.
And I'm his mom.
Sometimes, you know, you could have done better. Same goes for where you invest.
Can I get butt dials?
Level up and invest smarter with Schwab.
Look, guys,
Welcome back to the Watch List. I'm Sam Bartis, live from the floor of the New York Stock Exchange.
You're live
Joining us now to react to the Fed's decision ahead of this press conference.
We're currently building.
Chief Market Executive B. Riley Wealth Management, always nice to have you on the program. Thanks so much for joining us. Let's just recap what we've got here with obviously a poll that's widely expected, unanimous vote here. 9 out of 18 seeing a hike in 2026. A very hawkish dot plot. And as one guest we just had on pointed out, missing a dot. The easy bias and the statement I'm looking at has a lot of lines to it, so obviously revised significantly and much shorter as anticipated by some analysts. What are your initial takeaways here?
So, there's a hawkish dot plot, but the good news on that front is if Kevin Warsh gets his way over the course of the next couple of minutes, that'll disappear. And I think that when we think about the summary of economic projections and the forward guidance, that was a very useful tool post the great financial crisis when the only stimulus we had in the economy was monetary policy, and we wanted to make sure we were reassuring the marketplace that the Fed was going to remain easy and unless and until we had improvement. It just hasn't worked in normalized times. What I would argue with that might be coming down the pike as well is that getting rid of the press conferences, I think that's more on the chair of the Fed does a great job or has the ability to do a great job of describing what it is the committee's thinking about and what it would take for them to change their mind. The reason we went from 4 press conferences to 8 was the marketplace just assumed that any meeting that didn't have a presser wasn't going to make an action, so we had live meetings and things that weren't live. So I think getting rid of the press conference might be a mistake, but I think in the near term, getting rid of the summary of economic projections is long overdue. You spent too many questions saying, oh, you penciled in 3 rate cuts for this year, and the chair always has to pay attention. Don't look at the guy behind the curtain.
Yeah, I mean, Kevin Warsh has been pretty explicit in, his dislike for wanting to be at the mercy of and forward guidance. And so I'm just wondering, as far as the changes we're likely to hear this afternoon, looking out for, I was speaking to folks over at Charles Schwab earlier today who said they wouldn't be surprised if you made some sort of mention of the changing, at least in the communication strategy here. You've been doing this for a long time. I mean, how are the markets likely to react to that just because they've been so conditioned more recently with those press conferences and that forwards guidance?
Yeah, well, I'll tell you this. Everyone that's in my position likes the blackout period when we can't have any Fed speak. So if Fed speakers are fewer, not more, and we have less Fed speak on a regular basis during the off weeks when they actually can go out and talk, I think that'd be a healthy thing. So if that's part of the communication strategy where there's going to be changes, I would certainly be on board for that. I think that makes a great deal.
Escape the indoors with Cutter Backyard Bug Solutions. From lawn treatment that lasts all summer, or a backyard fogger for your deck or patio, and Cutter candles, perfect for summer evenings. Cutter, protect your people. Shop now.
Baltimore cut gun violence to its lowest level in 50 years. How? Instead of relying on police alone, they partnered with schools, hospitals, and others. Using shooting data, they identify those most at risk of violence. Those identified get an offer from the mayor. Change your life. We'll help with a job, housing, and mental health care. If you don't accept, police will intervene. Over 90% who accepted haven't been involved in a violent crime since. And it can work in D.C. too.
And how do you think the market is likely to react? Because we've already seen stocks turning negative, or that they do seem to have found their footing.
Deliciously
just in the last couple of minutes. We did see an initial strengthening in the dollar and a tick up in yields. I was actually looking at some historical data going into this over the course of Bernanke, Yellen, and Powell's first days as Fed chair, and actually you did have the S&P higher going into that 2 p.m. press conference with a subsequent sell-off into the afternoon session. Many were wondering whether Bush would see the first green day here. Obviously, a shortened trading week too, which you need to take into consideration. How are you thinking about all of that?
Yeah, so it's interesting. Every Fed day has its own sort of cadence, and you typically have the reaction to this dynamic decision, and then you have the second reaction, which is really one that's generated out of the press conference and what kind of new information it feels like we've ascertained during that time. And then you only had that 60 minutes of trading between the press conference starting and wrapping, and so whatever that move is tends to be the wrong move. It's unwound the next day. But to your point, with Friday being a holiday, tomorrow's our Friday, right? And if you're in New York City and you're going to be pretty quiet by 11 o'clock tomorrow, so I would say that the reaction function is different for this first day for Chair. And the reaction function likely gets pushed out the next week as we have two more time to disseminate everything we've learned. It would predict how changes. It's revolutionary. It's going to be one revolution, and I think there's so many changes, but we're not going to learn about all of those today.
Yeah, you raise a really interesting point because, of course, we have a parade outside our doorstep here tomorrow. I mean, you could suspect many people here probably won't be coming into work, so it almost feels like Friday's afternoon session is tomorrow morning, doesn't it?
Involuntary manslaughter, now what? We're going to drink the baby.
What sort of a mission do you think could
It's crazy to me. Fucking crack your fucking skull.
He's not going to commit to anything. I don't think he's going to commit to sounding as dovish as he did when he was interviewing for the job when we were in a different place in terms of inflation.
Stop praying to the Lord, boy. You see, I'm fucking round up. Can you feel that shit, boy?
I certainly think that commitment is going to set us in a place where we're going to shake things up a bit and have lively conversations internally.
And cheese, dog. That was a good stick, man. Fuck up my good stick. Yes, that's a little bit of stick.
You sounded a lot more dovish when you were interviewing for this job, and now it doesn't sound like you're
good stick right there, yeah?
The biggest surprise in the market right now is the fact that we had as many
dots that get your shit.
But if you look at the CME Fed Watch tool, you'll see that there's a 60% chance that we get a rate increase sometime this year. But that's no better than the dot plots. It's first predicted value. It doesn't really do anything. I think that's the only thing the market had to react to. We got real low surprises. The dollar firmed up a little bit.
Traveling, you'll have to carry a lot of weight.
Like 3 basis points.
Does a really good job.
I think everything's going to be about the press conference and how well he can keep the ball in the fairway.
Yeah, we're about 8 minutes away. Art, always appreciate it. Really nice to see you as always. Art Hogan, their Chief Market Strategist over at B. Riley Wealth Management. Coming up next, Kevin Walsh's opening statement. We hear from the Fed Chair about today's rate decision.
That's what's getting.
Hey guys, there it is. It looks pretty dang clean so far. Nice and it is. I think so far you're pretty happy, Reyes. Just how things are looking and coming together. I hope so. Taking my time.
I'm Sam Vardis, live from the New York Stock Exchange. When the market moves, we're on it. Getting the reaction, the strategy, and sentiment in real time. Stream Schwab Network.
One of these 13 bucks and change, but if you're feeding 2 people, it's
I don't think that's true, Joshua. That would be pretty hard. I think that rumor's false because I have carried that backpack.
Even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live access support by phone, email, and in-platform.
Gonna do one more, a little bit higher, so we can hold this other cable down.
My parents didn't really talk about money at all. In college, everybody around me had money. I didn't want anybody to find out that I wasn't middle class. I was using credit cards to do anything and everything. I ended up with $20,000 in credit card debt.
That's why we try to show this on every stream, because we really want people to see it.
My finances got wrecked and how I fixed it. And if I could do that, you can do it too.
No politics, no spin, just the market from open to close and beyond. Streaming
in some
24/7.
cases, like
any
this case
screen,
makes it really
anywhere
easy to do
at
cable management,
schwabnetwork.com.
just because of
what is up in this video. I'm going to show you guys how
They
to
know
open
what our
headset
family would
chests.
become.
I don't even know if they could envision it
Does
to
make it
leave
really
helps you guys
everything
out.
behind,
Consider
literally
leaving
come
a like and
across
comment
the
for
entire
algorithm,
world. I think that we
but do not
totally met
consider
with their
following me
wishes
or
were.
subscribing.
Schwab has
What we're
been
going
with
to
us for
do
almost
is we are
25
going to be
years
on
through
our
purchasing
homepage here.
houses, opening
What
up
you
our
want to do is
business,
you want to go
having
down to
children.
loot.
They've always been there for
After you go
us.
down to loot, you'll see your list of materials that you have.
Help me give my family a happy
There we go.
And your
Okay,
champions,
so we're in
your
good
champion
shape
charts.
now. Next up, let's get our
What we're
AIO
going to do is
installed.
we are just going to get through this.
Looks pretty clean so far, right, Brian?
Welcome back to the Watch List.
All the
I'm Sam
cables are
Barnes
nice
now
and
for a
hidden.
final look at what to listen for from Kevin Walsh's press conference. Let's bring in George Stillers.
And I like that because
George,
the
obviously
BTF
we're getting a lot
makes
of
it-
reaction here. The new chair's impact is already being
not
visible
until
in
I'm done.
today's
'Cause I use it to
communication. We've got
hide
the
the power
dot plot
cables
up
and
here
some of the
for
other
you.
stuff,
This is what Mohammed Alarian is saying right now, that the statement itself is significantly more concise, and notably one
So I'll put them
official
all back in
opted out
before
of submitting a dot
to that next
from these projections. So clearly we are trying to connect the dots here right now, given how we went into this Fed meeting, given how explicit Kevin Walsh has been around not wanting to be at the mercy of some of this forward guidance. Walk us through your initial take
Got
here.
that big, thick radiator.
Well, I think the initial take is a little bit surprising in terms of the conciseness of the statement. So I think there's going to be more emphasis from the market, at the very least, in terms of what the Q&A has going for Kevin Walsh coming up soon. I think one of the things to keep in mind is this is what I'm taking away right now. All of our stuff it looks like the rate cut narrative for this year is out.
To go.
First off, the other thing is if you look at the statement, they seem to be more focused on the aspects of inflation, and they're not really emphasizing labor market.
I'm just going to confirm.
The market may construe that as that they see that the labor market is sound and healthy, as well as the economy. So it looks like they're going to be a little bit more hawkish in terms of their statement, in terms of their statement, but also their language going forward. That's what it appears right now. I think if you look at the dot plot, interesting enough, and the median projection target for this year, if you go back to March, and I have their PDF up here right now, this is from the Fed's website,
come out of here.
the projection for this year was 3.4%. That implied some cut going back in March for this year, and now that number is 3.8%, which implies somewhere between where we're at now and some hike. Because there's about a 60% probability that there will be some rate hike going forward, but they seem to be splitting the difference between a pause and a rate hike. To me, that speaks to their outlook on inflation as being month to month based on perhaps a high inflation print that we saw in May.
Guys,
of course, based on energy prices. So it seems like they're going to be waiting in terms of their tone going forward until they get a little bit more data on inflation, which will be coming in the next couple of months.
One here for RGB.
Yeah, absolutely. And what have you made of the market reaction so far? I mean, it's interesting that obviously we've seen stocks turning negative on this decision. I've seen spot gold coming off as well. The Dixie firmed up, yields picked up. I mean, you had to squint to see that, but they have. You know, off the back of the fact that the decision was a huge surprise, but as you say, maybe some surprising elements within that dot plot, you know, just as to maybe how hawkish the committee did appear to be than many had anticipated, perhaps.
And here's the RGB.
Yeah, I mean, if you just look at you can see it on their PDF. If you just look at the measure of central tendency, if you look at the expectations now in June, relative to March, it's between 3.6 and 4.1%.
That's the termination of it.
Going back 3 months ago in March, the other SCP that was most recently published,
it's been a while since
it's between 3.1 and 3.6. So the entire central tendency, or the dot plot, has shifted by 0.5%. Which is more in line with what the two-year yield was suggesting in the last couple of months or so. The two-year yield also did jump about 8 basis points to now about 4.13%. Again, this was based on what I saw just a few minutes ago before we started
I don't think they're wireless.
our segment here.
Incredible technology.
And then we are going to go to hashtag chest. What you need to do is you need to make sure that you have a key fragment.
But the longer-term rates only jumped about 3 to 4
passively,
basis points.
or you can
So it
actually buy
appears that
these
longer-term
in the
inflation
store.
expectations seem to be well anchored, but maybe shorter-term expectations coming into the end of this year and perhaps into the first half of next year seem to be a little bit more uncertain right now based on what we know.
and you will get
with crude oil prices having jumped since February and of course come down below $80 as of the last week.
Okay, let me make sure.
And just going through some of this commentary as we await Kevin Walsh to take the podium for the very first time as Fed chair here, George. I mean, they did note the elevated uncertainty, particularly coming from the Middle East conflict, energy-driven supply shocks, keeping inflation pressures high. But we know that there is a view that inflation has been a problem for 5 years, I mean, which predates the Iran war. And, you know, some of it stems from this huge capex boom that we're seeing. I mean, Kevin Walsh himself has been pretty explicit. I mean, he's said this through editorials in the newspapers that he believes that the US is on the precipice of this sort of productivity boom, which is ultimately going to be deflationary. But many would argue that it will be inflationary before it's deflationary. So you just wonder how he's going to address that as well.
So the only thing is,
that's the thing. So if you just look at the capex, you know, non-residential capex.
Okay, George, I just have to cut you off here. We have got Kevin Walsh stepping up to the microphone in Washington, D.C. for his first press conference as Fed chair. Here we go.
It's an honor, a true honor to be back at the Federal Reserve and to take up this duty at a time of such consequence. I've been especially heartened by the warm welcome of old friends and new colleagues both. And I've listened closely to my fellow FOMC members. A lot of new ideas, new thinking, and genuine interest in moving the Fed forward. This week's FOMC meeting exemplified the very best of the Fed's traditions: rigorous debate, open-mindedness, commitment to mission, responsibility, and accountability for performance. In this business, they all add up to one thing: getting monetary policy right, or as near to it as we can do.
Living and learning here, guys.
That is our North Star.
It's part of the.
My colleagues and I are here to serve our legislative remit, which you've heard us say before: price stability and maximum employment.
There we go.
And these objectives
still pretty long.
Guided our business.
So what we'll do,
in the meeting just concluded.
Coming off the hub, just so you know, Brian.
As you saw a few moments ago, the committee decided to maintain the target range for the Fed funds rate at 3.5 to 3.75%, in support of the Fed's dual mandates.
Running off the hub.
The committee also reaffirmed its policy of maintaining ample reserves in the banking system. Economic activity is expanding at a solid pace, despite elevated uncertainty that owes in part to the conflict in the Middle East. Productivity growth and capital investment both strong. Job gains have kept pace with the workforce, and the unemployment rate has changed little.
This is why we didn't unscrew
We recognize that inflation has been running well ahead of the Fed's long-stated inflation goal of 2%. That's been going on for more than 5 years.
Take care of that. So now we have independent control for the VRM and all
Persistently high prices
kind of daisy chain
are a burden for the American people.
Okay, so now we have all that we need
for this. But the recent past need not be prologue.
So this is all of it. We're giving the KIO maximum potential here.
Members of the FOMC are unambiguous and unanimous.
So here's the VRM.
This committee will deliver price stability.
This is
at any institution,
you can't just get
it. A natural and timely opportunity to reaffirm its mission, to review current practices, and to consider whether those practices best meet our objectives. My Fed colleagues and I will be working in close collaboration to ask what changes might improve the conduct of monetary policy.
Okay, so that's all ready.
On that score,
there's all the cables ready for the
a difference in today's policy
and now
statement.
we know how this all works.
It's a bit shorter,
all we got to do is
a
hide
bit
it,
simpler,
which is great.
And it dispenses with some older language.
That part is nice.
That statement just gives you the facts
all of our
as best we can judge it. Absent also is so-called forward guidance, which we agreed was not well suited to the current policy conjuncture.
Okay, here
this
we go.
afternoon, you also received the usual summary of economic projections.
Nice beefy boy.
It's been the practice of this committee for participants to submit these projections, and I have encouraged my colleagues to continue to do so.
Perfect.
I, however, have refrained from offering any projections of my own, consistent with my long-held views on the SEP, at least as currently structured. In the median projections, real GDP rises at 2.2% this year, 2.3% next year, and total PC inflation runs at 3.6% this year, 2.3% next year. The unemployment rate stands at about 4.3%. The median participant judges that the appropriate federal funds rate to be at 3.8% at the end of this year and 3.6 at the end of next.
Okay, so we have it in.
We turn now to a few words on a key initiative that we're announcing today.
I'd call that.
I'm appointing a task force in each of 5 areas that are central to the broad conduct of monetary policy. First, Fed communications.
Might give it one more screw.
Second, the Fed's balance sheet.
Feels a little bit lighter
Third,
than I'd like.
our use and reliance on existing data sources. Fourth, productivity and jobs.
So you don't even get the items, nigga? That's lame as fuck.
Inflation frameworks. These subjects
we have that,
are timely,
room for
consequential,
some things. Okay, cool.
And in my view, worthy of a
When
fresh
they
look.
give you the keys, they let you open the box, but they don't let you keep. They don't let you keep the items.
For each of these independent task forces, I'm enlisting some of the very best minds.
Thank you very much
both
for the
inside
10
and
gifted
outside
subs, bro.
economics
Amazing.
profession. They will be supported by subject matter
very much,
specialists from our superb
Really
Fed
appreciate
staff.
that. Currently
And they'll
working
have
on
a
a commission
straightforward
bill, a little bit more focused than
Start
normal.
with first principles.
That sounds terrible. It's like I don't
Ask
care, but I
hard
do.
questions.
You know, when it's somebody's
Examine
perfect bill,
current
you know, I
practice.
just want
Consider alternatives. And ultimately,
Here's what we're gonna do
propose
here.
next steps for policymaker consideration. Since last summer, my colleagues discussed possible improvements in the form and function of Fed communications. This new task force will build on that effort, and I expect propose some well-considered changes, including to the SEP I mentioned a few moments ago. The second task force, the one on balance sheet policy, will review the benefits and risks of the current ample reserves regime and the composition of the Fed's balance sheet. They will assess alternative frameworks for the conduct and operation of monetary policy. The third task force, the one on data, will evaluate new information sources and consider methodological changes to improve data gathering, with the aim of giving policymakers more accurate, relevant, contemporaneous, and perhaps most important, actionable information on the state of our economy. Fourth, the task force on productivity and jobs. It'll survey the pace, the reach, the economic impact of new general purpose technologies, including AI, and explore the implications for the Fed in pursuit of our employment and inflation mandates. The last
Yeah, you send them in, and now you basically get a free chance to
drivers of
do this shit,
principles and weigh the full
which
range
is
of
lame as fuck.
for delivering price stability in a changing economy. You'll hear quite a bit more about these task forces and this overall initiative in the coming weeks. Enough for now to make a simple statement. Each task force will serve an objective shared by everyone in the system. Shared by
What
everyone
the
around that
fuck,
table.
bro? That's lame.
A Federal Reserve that is clear-eyed about its mission. There
we go, yeah. It
fit
took up
for
all
purpose,
I guess I go look it up.
future. And with that, I appreciate your attention. I'm happy to take your questions.
Now it's peeled. Look.
Hi, Chairman Howard Schneider with Reuters. Good to see
There
you
it is
again,
right
and,
there.
and welcome
All
back.
on the- all on
this is
the-
a lot to
the
be put
peel.
in motion
There it is.
so fast. What
Did a
is the
good job. It's all
timeline you have in mind for each of these?
So, I think it'll depend.
A good Narskin has to find a way to integrate both his forms into its concept. Whatever the skin is doing, it has to suit both Mega and Mini. That's not as easy as it sounds, and sometimes it goes wrong. And Snow Day probably stumbles the worst here. The concept of Snow Day is that everyone is out having a big cheerful winter wonderland snowball fight, and after that, everyone's going to go home for hot cocoa and warming up beside the fire. And the Yordle form works great for this skin line. He looks adorable in his little fuzzy hat and his scarf. It's wonderful, but it just doesn't gel with the mega form. He becomes a huge, saber-toothed murder wolf monster, which even the skin's own lore says likes to tear people in half. And with that dissonance, yeah, the tone of the whole thing just completely collapses. Like, maybe this would work if NAR turned into a...
2% as a point estimate is too strict?
Let me break that into two pieces. First, on the inflation framework review,
and pick up the real
their remit is what are the drivers of inflation? What's the Fed's responsibility for inflation? In part, how do we measure inflation? But that'll overlap with my data group. On the 2% inflation objective, that is the Federal Reserve's long-held objective of 2%. You've heard me say before, I tend to focus on the left of the decimal point. Well, the 2 is the left of the decimal point. For now, 0 is to the right. I see no reason until we have reestablished our commitment and ability to deliver on the 2% inflation objective to revisit that. So that'll be outside the scope of what we're taking on.
Colby.
Thank you so much. Colby Swift from the New York Times. You've in the past said that inflation is a choice, and in the policy statement, it includes this pledge to deliver price stability, as you've reiterated today. But looking at the SEP, the bulk of your colleagues expect core PCE to run around 3.3% by year end, and for the 2% inflation target not to be reached until 2028. So I'm curious how patient you think the Fed can afford to be at this juncture in terms of waiting for one-time inflation waves to wash through and for underlying inflation to step down after so many years of inflation running above target, and under what circumstances you would support the Fed taking some action and raising rates.
Sure. So quite a bit there. Let me try to break that into pieces. First, we have the capability and commitment to deliver on our price stability objective of 2%. That's exactly what we're going to do. In the Fed's review of its strategy over the last any number of years, in January, the Fed, including the strategy that we're still bound by, the Fed statement says that inflation is primarily determined by monetary policy. You bet it is. I've said for years inflation is a choice. Today, I'm announcing that this committee unambiguously and unanimously have decided we are going to deliver on that. The rest of your question sounded like an encouragement for me to give forward guidance. We've dropped forward guidance. Some along the committee, I think, dropped it, I suspect, from our discussion the last couple of days, because they said at this moment in time.
I guess we're going to deconvolute that on.
Others have, I'd say, different views and think as a general proposition, forward guidance isn't the business we should be in. But that'll be taken up by the Task Force on Communications and my policymaker colleagues. We're going to listen hard to what the experts say and make our own decision.
Yeah, now I have 300 of these people, dude. But then they make them jump so quick and the goddamn
following up, I guess, on the current
Dawn Bringer.
I am curious how restrictive you think things are at the current moment, given the flow of data that we've seen and, you know, forecasts that are coming down the pipeline.
Yeah. I've heard characterizations both inside and the Fed about that. I'll give you my own. It's uneven. If I look at the housing markets as one example, Fed policy isn't the single determinant of the state of the housing market. So even if broadly, I would say there, Fed policy appears to be somewhat restrictive.
Immortality bearable.
I would have a hard time managing to say those words if I were to see what's happening in financial markets. So I'd say it's
legit, dog, man.
Mechanisms of monetary policy, whether monetary policy is coming from our interest rate tool or our balance sheet tool. But the good news, we have a task force on that too, and the balance sheet task force will be looking more at that subject.
You said you don't like forward guidance. You dropped it from the statement this time. But with the dot plot, 9 members suggested that they want a rate increase by the end of the year. Betrayed. And the markets have taken that as forward guidance. So what does this mean in terms of how you guide the markets and in terms of what the dot plot's future is?
I'm going to have to give you the same answer I gave to Ms. Smith. We've got a task force for that. I'll give you a little bit more. I reviewed the dot plots. And when I saw the submissions, I noted that all the submissions were coming in with pencils. You know, those kind with the big erasers. That's to say that I think my colleagues around the table, when they submitted their dots, understand the world is changing quite quickly. And they didn't feel bound by them 6 weeks from now or 6 days from now in the event that their circumstances change. I'll note a couple other things. What I heard around the table was, as they submitted their modal forecasts, to be clear, this was more likely than not. This was more likely.
Wait, that's a legit skin right there.
So I did hear.
They sort of let me have that joke. What's doing here?
I did not submit a dot. For me, it's not helpful in the conduct of policy. I suspect by year end, as I mentioned in my opening statement, there'll be a review about communications, press conferences, dots, meetings and the like, transcripts, minutes. This will be part of that. I don't want to prejudge the outcomes there, but I'm pretty open-minded about what they could be. And I was just incredibly impressed over the last couple of days. My colleagues over the last 2 days,
we're going to find out the use of videos for the front of you and
changes and easy, changes filled with risk. Our number one goal is to get monetary policy right. The way to get monetary policy right is to deliver on the remit that Congress gave us, to deliver on price stability. And there was no disagreement on any of those points.
At the risk of possibly getting the same answer about task forces, communications, what is your feeling about these news conferences? Are you going to continue one after every meeting? Do you find them useful? What is the future for the way Kevin Warsh will communicate?
Well, this one's probably got another 15 or 20 minutes in it, so I don't want to prejudge the outcome.
Black Angus, French onion burgers
that are made
with
households, businesses, and more broadly through using the likes of
what is your secret here?
a great old mentor named George Schultz, and his mantra was press conferences are useful, but when you have one, you want to make sure you have something important to say. There's something important to say about our commitment to deliver on price stability, our commitment to rethink practices with an eye of moving the Fed forward, and to give you and the American people a sense that these aren't idle thoughts, these are concrete thoughts, that we're going to seek out the best minds, the best thinking inside of the Federal Reserve, the best people I know in business and economics, and technology and the rest, to share their views. That's what we're going to be doing here in the pursuit of truth. I think we're going to come up with some new and interesting things. We made some changes today. I expect more changes to come. And some of those might well be worthy of a press conference.
It's so delicious. Really good.
Taking our questions. Could you give us a sense of how you see inflation more in the long term? I know you may not want to comment on the ups and downs, but is this mainly driven by energy prices in the Iran war at this point, or do you have any concerns about underlying inflation pressures at the end of the term?
So I can't do much better than the committee. So let me restate it. Inflation remains elevated. Driven price increases in certain sectors, including energy. The paragraph goes on to say, but to be clear, the Fed will deliver price stability. Our judgment is the committee spent quite a bit of time, not just in 2 days, but iterations of a couple of weeks. Fair to say about inflation, but the paper is strong, unanimous, and unambiguous. And that's, I think, an important message. We missed for 5 years.
Just on your data task force and everything else, I mean, generally speaking, I think people feel the Fed looks at everything already. Certainly that was the sense from before. Is there data that is not giving enough weight? Fed members. So what is that task force looking at, and what might be the, I mean, I know you don't want to prejudge the outcome.
Let's stop at the same.
Are there examples of
$50.
So you're answering my question, so let me say I don't want to prejudge the outcome. also don't want to say too much about what they're going to do because I still have a phone call or two to make before I've nailed down the people that are doing that. I'm interested in what the outside experts and the is on the subject. Say this, most of the data that central bankers and other government officials in the United States consume come with old-fashioned survey methods. National accounts of what the U.S. economy looks like. It looks very little like the U.S. economy in 2026. Survey methods that don't have response rates that we need. Asking questions that might have been quite applicable a generation ago that are less applicable now. So inside statistics, be open-minded if the task force and our own best thinking recommendations how those official statistics can be brought up to the standard of our time using new analytic methods. I'd also say this. Almost every private company CEO that's running his or her business are doing so with real-time information that isn't subject to much revision. That is telling them what just happened at that very moment. As you know, there are what we're really interested in is what's happening right now. What we're less interested in is echoes of history. We're hearing from my answer that some of the data that we receive, that we're waiting on, the first Friday after the month, the payroll index or something else, that might be an echo of history that's quite useful on its third revision. We need to take those error bounds down because we have to make hard decisions in real time. Sources that we can learn from the private sector, from the official sector, and analytic techniques far more time than asking a simple question about whether something was core or non-core.
Thanks. Welcome, Mr. Chairman. Everyone's with Fox Business. So if you don't give a lot of ongoing forward guidance, won't the markets have more volatility, and should Americans have more access to what you're thinking going forward?
So I think financial markets perform best.
As a tech founder, we start scrappy.
I think
you have to
financial markets
live that.
less
Pull 2 on-editors in a weekend to launch Codex and make sure it was live. I thought of Azure as what only the huge enterprises use, but I learned that its power and resources were amazing for a startup like ours. Teaching the next generation of technologists is why I started Codex. There are lots of videos on the platform featuring our team, but they take forever to make. And it's impossible to keep up to date with everything changes. Now, in less than 24 hours, I can build an AI avatar courses for the visual learners and update them dynamically as needed. Because Azure gives my team all the tools they need in one place, tools like Azure AI, compute, storage, we save time on building, which means we get an extra week to gather user feedback and refine from there. And that's just a fraction of what we do with Azure. We can do a lot for tech startups like yours too. Sign up for a 30-day free trial today and let me know what you're building in the comments.
Think is reliable.
With all these Hilton Honors points, I could stay for free. With all of Astoria and the Maldives. What about the canopy in Paris?
Hilton
Honors, babe.
When you want points that can take you anywhere, anytime, it matters where you stay. Hilton, for the stay.
Told us to do, and that we've got to get in the business of doing.
Yeah, if I could take you in a little bit. This is your first meeting. The board members seem fairly hawkish when you listen to, in general, when you listen to what they're saying. Was there any discussion of a rate cut going forward today?
There was one proposal on the table. There was no discussion of any other proposals. The discussion on that proposal, I would say, was quite limited. The group was unanimous and unambiguous on it. It has been the practice of this central bank and others to have a range of alternatives. Today we had one. I thought it furthered the discussion, deepened it, and made it clear what we needed to do and how we needed to deliver. I wouldn't prejudge what happens in the future, but there was only one big subject for us. We took it on. We had a good family fight on it for a couple of days, and we ended up, I think, in a better place.
That was Kevin Ward. Walsh giving his first press conference as the Fed chair, and obviously we saw markets seesawing throughout the course of that press conference as those questions went on. There's been a lot of reaction from some of these market participants. Just running you through a couple of them before we get to George Sillis for his thoughts here. Mohamed Al-Arian saying that basically he underpinned his emphasis, Kevin Walsh, on accountability. His delivery was noticeably more open, engaging, concise and honest. One of the biggest takeaways was that task force he's looking at for communications, the balance sheet, data sources, productivity, jobs and inflation. He was asked about the timeline. It looks like a few weeks, and by year end this could be in place. Liz Ann Saunders saying by announcing this, Walsh is sending a clear message that the changes are coming soon, and as they map out the plans right away, Claudia Sam says it's not going to fly. So George Sillis, what did you make of what he had to say? He was pressed a lot from journalists about that forward guidance.
Yeah, I mean, I think this is interesting. I think what they're doing is, establishing a new leadership framework, and I think that's a good thing. I think the forward guidance aspect of their change is important as well, because we're going back to Greenspan now, where there's not necessarily a lot of hand-holding into the meeting, so the markets will be a little bit more volatile forthcoming in terms of policy meetings and, of course, the announcements. I do think that there's still a lot of strong capex that they really are emphasizing as holding up the economy, because they talk about how interest rate policy is becoming a little bit more uneven with housing market struggle, but equity markets and capital expenditures have been strong in holding up our economy. I think the task force makes sense in terms of bringing up more ideas and the unanimous aspects of their policy stance on firmness on inflation. So they seem to be still, very much focused on dealing with inflation and, of course, evaluating the balance sheet mechanism, which has been, changed slowly over time. But nonetheless, they'll be evaluating new tools and mechanisms to enhance the balance sheet tools that are used for quantitative reasons and liquidity provisions.
George, we really appreciate you standing by, listening to that press conference and giving us your initial thoughts here. I mean, I thought it was interesting. There was much more of a focus on price stability there than the job side of the mandate, but really appreciate your time here, George. Thanks so much for joining me here on the watch list as well. Our special coverage of the Fed continues with Market Close on Close coming up next with Marley Kate.
So what is unique about Schwab Coaching is the community.
There's a lot of energy, like-minded people.
It's nice too. That's it. 39, it's 98.
Some of you want
6 days.
with you and some clients like to be in the privacy of their own home on an online live interaction.
You got it now. You done learn that sales shit. You just got like a good like the market. This how you have your company. Because y'all bring down the price, like I always say. Because things that are unseen are things that they couldn't see them. Because now I gotta drop the price, just like the house. Because they know buyers. They get out. One sale. But now I gotta stop being so cute. Instead of cheapest, I'll pay people. Before that, then they go to that other thing they don't show people, where they just jumping all over the walls. Flat rate just to get it into my inventory, because now it's losing me money because I can
For instant reactions, earnings breakdowns, and hot takes that teach you about stocks and markets, follow me on X at Petalides and connect with me, Nicole Petalides, on LinkedIn, Facebook, and Instagram.
On the first, and they give the time to come please. They want to eyeball it and they be in that other little dog. They don't do we want to for this shit. The food from TJ must.
Welcome to Market Matters. I'm Marley Caden. Each week, we're stripping away the noise to focus on the big picture economic themes that could have a place in your portfolio. Today, we're diving headfirst into a sector experiencing a restructuring of historic proportions, the global alcoholic beverage market. The data shows that in 2025, U.S. alcohol consumption declined in 49 of 50 states.
That's very bad of the...
The mistake that the industry made was thinking that that was a new normal. I think it was just a wishful thinking, a level of optimism that was clearly incorrect.
Joining us to separate the real data from the media hype is Martin Lodevegs, the president and managing director of IWSR, the intelligence firm that Wall Street and multinational beverage giants rely on for strategic forecasting. Coming up, we'll discuss the real impact of trade wars and weight loss drugs on consumption and how investors can spot the winners in a restructured landscape. We've got all that and more next. Martin, thank you so much for being with us. When I spoke to you last about some of the recent data that you had put out, I wanted our conversation to keep going, and we both disclosed that we love a good bottle of wine and some other drinks probably on top of that too. So now's our time to talk about it. But before we dive into all of the booze data, let's talk about you for a moment here, because you haven't always been the beverage alcohol data specialist. You had a corporate career before that. So I'd love it if you could just walk our listeners through the path that got you here.
Thanks, Mark. It's great to be here. This is a story I've had to practice a number of times because I had to try and explain to my mother how I got here, and she doesn't understand it to this day. But I'm South African. I grew up there. I studied there. I studied physics, which is partially why my mother wonders how I'm in the alcohol industry. I left there and I went into consulting. Sort of, it was one of those typical stories where I had no idea what I wanted to do, and someone said to me, "Well, species, whatever it is, sort of figure out what you want to do."
Oh my God! Now they're gonna be spraying the cow. Oh, that's spray the cow down. So that's all this is. Then one of the times of them having too many of these things in one place, and they not spread out like they normally be because they want to maximize. They got them all.
Acquired by AB InBev.
So here they can move away from that shit. If they got near them, they can just run away. Now they stuck, and then they can poke each other in the bra. So they put in unsanitary conditions.
I kind of left. I briefly went back into consulting because I still didn't really know what I wanted to do with my life. I realized that actually consulting wasn't really it, and I really enjoyed the alcohol industry, and so that's when I joined IWSR, who kind of look at everything. So I enjoyed the beer industry, but there's so much more to learn. Ready to drink beverages, and I just sort of enjoyed that holistic view of kind of what's happening in the world. And basically, my life now is talking about alcohol.
Carolina
I don't think it's exclusively just talking about alcohol, because when we were getting set up for the pod, I know you have a fun night ahead of you where some of the data gatherers for the company have brought back exotic alcohols from their travels. And what is that like? You went from these beer titans to now being on the other side of studying these global trends, but you also have access to types of alcohols that some of us have probably never even heard of.
The story here is we do annually after we release our latest data, which was at the end of May, which I'm sure we'll talk about. All of the researchers gather to do a bit of a post-mortem of the research cycle, like what worked, what didn't work, where do we need to spend more time, where do we need more information, data, so we kind of gather together to sort of have that session. The long tradition is when they are in market doing their research, which is literally everywhere in the world, they buy the weird and wacky and random drinks that they discover, and then they bring them all together. And today is the day where they're all getting familiar, let's say, with all of these products.
But let's talk about that data as it applies globally, because you've released some new data, you have some more data coming out, but overall globally we're seeing total beverage volume declining in multiple categories across multiple countries. As you look at the trends and how things are setting up, what is sticking out to you, Martin? Because I mean, you've been knee deep in all of this in some way or another for years now. Was there anything that was really surprising to you in the most recent data?
Yes and no. I think when the industry is having a tough time, I don't think anyone is doubting that. Now, there might be players within that and pockets within that are seeing some green, but to your point, on the whole, the global picture is one of decline.
That read this paragraph out loud. Because the only thing that makes a reading person is their ability to read it. And then they read it again and they can grade them, and after they grade it, they? I guess it was public speaking. Did they not give them public speaking?
A fairly universal trend, right?
Do they? I mean, it's something you can do in one day.
If you look, and most of the growth is coming from your sort of your Indias, your Brazils, Mexico,
that's
South Africa, so
brothers.
Latin America, Africa, India.
Those
markets are still growing, but that growth even there has slowed somewhat. It's because of the fundamentals, because population those are all growing countries. Most of them are sort of economically fairly well off, but again, that sort of macroeconomic there. So a couple of years ago, the global picture was positive because the growth rate out of the growing markets was enough to offset the declines elsewhere. That sort of overall slowing of the market has just made has pushed that global number into the red.
Basically, the thing is, you get it, you can unlock it, but then if you don't pay for the essence, you can't get the skin. So now, but I done figured out that if you disintegrate the stuff, it'll give you the material that you need to buy it. So basically, so it can stay free. I ain't trying to buy nothing. So basically, you gotta, in the beginning, you gotta disintegrate maybe something that you want, and then they'll give you a little for what you disintegrate. So they want you to. They need 1,000 pips to get it. I only got 300, but even if I disintegrate both of them, that's 500. I guess that's close. Yeah, like
growth is just going to come from other places and not from the traditional heartland
I made a presentation.
Those are sort of in decline, not really expected to recover, and really the growth is going to pivot to these other economies.
So you mentioned the U.S. may be usurped by India in that short time frame. I mean, you're talking 6 years here, not even, or halfway through 26, so 5.5 years. U.S., one of the hardest things, I want to look at it here, we're down 5% in volume, 4% in value. Volume dropped in 49 out of 50 states overall in America, but then you mentioned India, they're up 5% in terms of value. I'm looking at South Africa, where you're from, their beer market is surging. As you look at this and you say you don't expect it to get better in the near term, are we also witnessing a structural shift here where alcohol, peak alcohol consumption has maxed out in the West and now it's all going to be driven by emerging markets?
Very possibly. I don't know if last time we spoke about market maturity used by some in the industry to sort of predict the way in which categories will evolve in the marketplace. So it's a fairly well understood pattern that as markets grow economically, the amount that they drink goes up. Obviously, they've got more disposable income, and alcohol plays a bigger role. But the categories also evolve within that space. So it tends to be sort of beer first, and then sort of spirits start to enter, and wine starts to enter really around meal times. And then at some point they sort of peak, start to slow, but they tend to slow volumetrically while still growing in value terms. So it's the sort of the concept of drink less but better. So we've seen that in kind of Western Europe for a pretty long time. I mean, I think Germany has been in decline for, I think, close to 20 years. A slow decline, but just sort of a steady reduction in consumption. The UK, I think for the last sort of 10 or 15 years, and all of these markets follow a similar pattern. The US has bucked that trend up until about 3 years ago, 2-3 years ago, so the end of 2023 was when it really started to dip. Now, the question is the US now on that same path? Have they hit that peak and are coming back down? Obviously, difficult to predict. Our expectation is that it will continue to sort of slow a little and then eventually stabilize, but that time frame is probably in the sort of 6-7 years before it stabilizes. And really underneath that is then the category switching. So consumers are moving from one product to another, and
a hot dog for every country where Visa is accepted. Australia, Canada, Mexico, Argentina, United States.
Why play Cy on top? Well, he has infinitely scaled health, he brings very strong engage, he has great AoE damage and lockdown, and he's an amazing split pusher. However, he is weaker in the laning phase, and he can struggle into strong duelists. Scion's passive is when he dies, he briefly briefly enters stasis and then reanimates into a frenzy. During this time, he goes back up to full health, but it rapidly decays. He can only move and attack, and he gains a large amount of attack speed, life steal, and his attacks deal bonus damage. Also, all of his abilities are replaced with one cast of Death Surge, which gives him a massive burst of movement speed. Sion's Q causes him to stand in place and charge up the ability. While charging over 2 seconds, the ability's range, knock-up duration, stun duration, and damage are all increased. Scaling health. He brings very strong engage, he has great AoE damage and lockdown, and he's an amazing split pusher. However, he is weaker in the laning phase, and he can struggle into strong duelists. Sion's passive is when he dies, he briefly enters stasis and then reanimates into a frenzy. During this time, he goes back up to full health, but it rapidly decays. He can only move and attack, and he gains a large amount of attack speed, life steal, and his attacks deal bonus damage. Also, all of his abilities are replaced with one cast of Death Surge, which gives him a massive burst of movement speed. Sion's Q causes him to stand in place and charge up the ability. While charging over 2 seconds, the ability's range, knock-up duration, stun duration, and damage are all increased. Upon release, he deals damage in the area and slows all enemies hit. However, if the ability was charged for at least 1 second, when he slams his axe down, he deals damage to enemies hit, then knocks them up and stuns them. Sion's W has a passive where he gains 4 bonus permanent health whenever he kills an enemy, and he gets 15 whenever it's a large enemy or takes down an enemy champion. The active grants himself a shield which scales with his max health, and this ability can be recast to consume the shield to deal damage to nearby enemies in a circle around him. Sion's E is a straight line skill shot which deals damage to the first target hit, slows them, and reduces their armor. If the target was a monster or minion, it knocks them back and stuns them, and enemies hit by this minion are dealt damage and slowed. Sion's ultimate causes him to start charging in a direction towards your cursor. During this time, he ramps up movement speed and stops when hitting an enemy champion or terrain. Enemies hit are dealt damage, slowed, and briefly stunned. For combos, start W into E and Q. Charge Q as long as you can before walking up, exploding your shield and attacking. Your all-in is to ultimate and use W while running. Upon impact, hold down Q for as long as possible before detonating your W, use E, then attack away. For matchups, Sion plays very well into ranged top laners as he easily gets onto them as the game goes on. However, he can struggle against champions who can easily get on him and stay on him. For runes, take this, Grasp makes you even tank.
There was societal change that then started to impact the choices that consumers made and the behaviors that consumers exhibited. And that's where you sort of get the rise of like ready-to-drink beverages, particularly came in many ways out of that period because people were just experimenting a lot more, trying a lot of new drinks, drinking in different like day parts, and those behaviors have kind of been fairly consistent. So it's more the sort of consumer trends that changed, whereas the underlying fundamentals of the categories have largely tended to be consistent.
I'm glad you brought up those ready to drinks because that's where I was going here, just sort of this massive rise of, I said White Claw earlier, but we've got Cutwater, Surfside. I'm a big fan of High Noon. I've probably tried all of them in fair defense. I admittedly confess that my knowledge about COVID drinking was from experience. But RTDs, I think, weren't taking that seriously when they first came out. I don't know that they were looked at as something that was going to stick around here. They were almost sort of talked about in a fad-esque hype way, I remember, and I was trying to go back all the way into the teens, and IWSR continually highlighted them as a structural growth category and everything that I could see, and as I was looking at the data, it was the only major category to grow in 2025. So when you look at RTD, I mean, the US is the biggest market. We actually ticked down, I think, in 2025, but just by 1%. Do you view that as Americans reaching a fatigue here? Are we looking for that next hype fad thing, or are there just too many options, or is the market just hyper fragmented right now?
I mean, we could have this entire conversation just on ready to drink because it's I think by far the most fascinating category because what's happening there is I don't know if unique is the right word, but it's so convoluted, but in a really fascinating way. So I think you're right. I mean, there was a strong view or a fear, I think, by many that ready-to-drink was going to be a fad. It was going to be a boom and bust. And if we're honest, right, ready-to-drink isn't anything new. It's been around for 40, 50 years. But it was always tiny, and it did tend to have a very faddy kind of pattern. Like you had Alco-Pop boom and the wine spritzer, wine cooler boom. It doesn't last very long. They tended to be quite geographically located, so you get a boom in one market, and then a few years later, you get a boom in another market. There was no sort of common pattern to it. So I think when the big boom happened in the US with hard seltzers, the rise of hard seltzers initially, there was a bit of an expectation that this thing was going to happen. But I think the reason why we were convinced that that's not a fact is because while the boom in the US was the biggest, it wasn't unique. At the same time, you started to see the boom of ready-to-drink in a lot of different markets. Furthermore, the type of ready-to-drink that was booming in these different markets wasn't always the same. So it wasn't the same type of product being launched globally, getting a few years of success and then declining again. You tended to have a lot of different types of ready-to-drink beverages performing differently or performing well in different markets. And the reason that matters is that it's coming from consumers. It's a consumer pull as opposed to a big brand owner pushing a successful brand for a period of time. I think then because of that sort of underlying success, you started to get a lot more innovation. This also then coincides, as I said, at that point in time when things started to get difficult. And so a lot of brand owners were looking at the rest of their portfolio and saying, oh, it's not doing very well. I need to top up my P&L. And there's this ready-to-drink thing that seems to be doing quite well. And so there's a lot of innovation behind it, a lot of people entering into the space. And as a result, a lot of products coming to market, right? When you've got so many people coming in, you have a lot of products coming in. And so it was a real bonanza for consumers because there was all of this diversity, all of this optionality. And I think importantly, it came at a point in time where that economic pressure was really starting to be felt. And the reason that matters is that a ready-to-drink, a can of a ready-to-drink is fundamentally cheaper than a bottle of wine or a bottle of spirits, right? Comparable to a beer, but in many cases, the ready-to-drink drinker is someone who doesn't want beer. So their alternatives would have been spirits.
It doesn't sit well with us.
No, $19, easy flavors, $8 for a can of no stuff. Go buy that shit yourself, and whatever the nut with some raisins and your own bread.
I don't have to buy a mixer. I don't have to
go to mom to have all the nuts in it.
I'm flashing back to the box of Franja that we used to carry in college, pre-hard seltzers. And yes, a can is far more convenient than carrying a boxed wine, which usually ended up on someone's shoulder. I'm really aging myself with that one. But I was flashing back to, I wish I had a high noon to carry around instead of the handle on the box of wine that eventually broke at some point during the night.
No, exactly. It's just, it is more convenient, right? It obviously has the convenience. The other thing that ready to drink has, which is it's more difficult to sort of
you know, it ain't worth it. But they fucking hide it. You know, people, we want to watch that. Spending all that money for raisins.
You would drink the
blueberry, dry blueberry raisins.
If you came with something else, a bottle of wine or anything else, then you're somewhat out of the occasion. You're the outlier. You're a little bit different. You're the person who now needs a glass. You're the person now who needs this thing chilled. You're the person who needs a corkscrew so that it can be opened. As opposed to you just sort of seamlessly enter into the occasion with the same type of thing that everyone else is drinking. Sure, it's different flavor, it's different packaging or different color, but it's the same thing. You crack open the can and there you go. And I think people like that conformity to a certain extent. And in this instance, they can kind of conform at the fundamental level while still getting the flavor or the product type that is of interest to them. So it also plays that role, which I think is it's subtle but quite important in a lot of instances.
All right, since I dragged us back to college, I'm going to talk about Gen Z now, since they're all in college right now and what they're doing, because I know we spoke briefly last I talked to you about how Gen Z is sort of taking the hit for all of the changes in these alcohol trends. They are in all the headlines about how they don't drink and they don't go to bars, and they're the reason alcohol consumption is down. But that narrative isn't actually true, is it, Mark?
Well, yes. So first off, it is true that they get blamed for everything, which I think is a bit unfair. But as it relates to alcohol, again, this is quite an interesting one, because what we're seeing is they just came late to it. And it's actually true in a lot of facets of their life, right? I mean, you see Gen Z living at home longer, people living at home longer than prior generations. The same is true of drinking. So if you kind of go back 5 years, the participation rate, which is kind of the percentage of Gen Zers who drink, was definitely much lower than the average participation rate of the population. And so at that point in time, people were saying, oh, I see this Gen Z cohort, they don't drink, they're not interested in alcohol, and it's the end of the industry. As time has moved on, you're starting to see that participation rate climb and climb and climb every year, heading up and starting to normalize with everyone else. So it's not that they're not interested in drinking, it's just they started it later. And if you kind of go back, 5 years when the pandemic hit, the oldest Gen Z were 21, 22. So pretty hard to start drinking when everything is shut down around you. And so it kind of makes sense that cohort needed a couple of years for the pandemic to recede and for those behaviors to sort of embed themselves a little bit more definitively. And now what you're seeing, obviously, is the even younger Gen Zs, they don't even necessarily remember as much of the pandemic, and they're entering college in much the same way that prior generations did. And so you see those drinking patterns normalize. That said, they have less money than anyone else, and if everyone is feeling the economic pinch, Gen Z are feeling it more than most. And so they are a lot more cautious and thoughtful and don't drink quite as often as other markets. So volumetrically, there is an impact. They are drinking less than others. So it's not less people drinking. It's just that the people who are drinking aren't drinking as often because they can't afford to. And so that is starting to see reflected again. If you believe that the economic malaise is going to ultimately recover, then they should recover along with it.
We've come to the part of the pod that we call the sprint. It's just rapid fire questions. Answer the first thing that comes to mind. It doesn't have to be a
probability of me understanding this.
I assume you're probably heading tonight once you guys finish your tasting event that you're having.
It's a bunch of berries. Even if they comes up, that's a bunch of berries. They advertise all the nuts, but in reality, you get like a container full of berries.
It's still early, so it'll be a bit.
Let's take the cherries, though.
Okay.
Cherries, berries, and nuts. Like the cherry. You know, you probably get a lot of cherries, you know, like the nuts. I mean, like the blueberry with berries and other little cherries.
I love hard teas. Surfside is just such a special thing for me. I thought we were going to be friends,
Cranberry.
It's massive and it's growing and it's doing incredibly well. So I don't think it's a fad from that perspective. I don't get it.
Well, I'm contributing to that growth on that end.
Most people are. I'm the outlier in this particular one.
That's all right. Maybe we'll get you on the bandwagon at some point. I'll give you a little. I'll send you a little sampling. Although I'm sure you've probably tried all of them.
I think I've had
you
them.
definitely have. You probably know 20 more than I do. Most underrated alcohol trend.
Mezcal.
Okay, mezcal. Worst alcohol you've ever tried.
Ever tried or ever had a lot of, because I kept drinking it despite the fact that it was awful.
Pick your poison, whichever you want.
So there's I probably shouldn't be saying this. There's a drink called Fernet Branca, very popular in Argentina, and they drink it with Coke. The spirit itself tastes absolutely, I mean, it's a digestif with all these herbs and things in it. It tastes absolutely horrendous. Mix it with Coke, though. It's quite fun and very popular in Argentina. I lived there for a year, and I had far too many of them, despite the fact that, if I'm being honest with myself, wasn't very good.
You can get Fernet on draft here in a lot of bars in Chicago. You can also get Malort, which I'm going to take I'm going to take a hit on this one from the Chicagoans listening to, but that is one of the worst I have ever tried. That or Everclear. Those are on my list. Biggest threat to alcohol: cannabis, GLP-1s, or moderation?
The fucking alcohol is cannabis, GLP-1s, the fat drug, and moderation. They're smoking that gas. Gas smoking weed is way bigger than liquor. The friend talking about some exchange your restriction and all that stuff. Like, nigga, give you some of anything. Which is what they scared of, because then people will be like, hey, second. They're doing supporting the use. Supporting this beast system that does nothing for me and nothing for my family and nothing for my family, nothing for people 1,000 years ago, but for people 10 years ago, think it's going to do something this year. They've only support people like Donald Trump, which are way beyond our whatever.
For me, will non-alcoholic wine ever taste good enough to drink? Will it ever actually mimic real wine?
Yes.
Yes.
And about gas, $3 extra gas. I'm like, God.
I mean, it took the beer industry 30 years to get beer to taste, non-alc beer to taste.
Couldn't buy that expensive ass gas or stop driving places.
5-ish years, 5 to 10 years.
Or whatever.
So I think eventually they'll figure it out, but it's still going to take a while, I suspect.
We really appreciate you joining us, Martin, to take a closer look at all of the trends that we're seeing and breaking down some of the places that are getting a bad rap in the alcohol industry and other places that are not getting the rap that they should be. But go have fun with your team, and we really appreciate you bringing your insight to the podcast today.
Thank you so much, Marley. Have a great afternoon.
Thanks again to Martin for joining us on this episode of Market Matters. A few things really sticking out to me from our chat. First, it's these ready-to-drink beverages. They are not a fad. They're not a trend that's going anywhere. They are here to stay, and whatever the next big thing in alcohol is likely going to be in a can. Also, tied to the next big thing is when Martin said, quote, "The future is here. It's just not equally distributed." That next big booze trend or hot alcoholic item, it's already out there. His team has likely tried it in another country or an unpopular bar, but it will find its way to the mainstream and continue to change the landscape in the same way that we saw with hard seltzers. And then lastly, the belief that things aren't going in the near term. Martin says we've got 3 to 4 more years of these downtrends until we start to see some stabilization on a consumption front. We need to have more money to spend.
Come on, give me a good skin.
Feel more comfortable spending on alcohol and socialization. But what that landscape looks like at
and some essence.
Martin probably knows.
Come on, big money, big money, big money.
With the general. It was a great chat with him, but we are going to have to leave it there today. I want to thank you for being with us. This has been Market Matters. You can find us wherever you get your podcasts. Please make sure to rate, review, and subscribe. I'm Marley Caden. We hope you'll join us again next week.
Trading at Schwab is powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions.
You can't drink this. You work it. Maybe you might be able to trick in the bag, hit full of bag, but the way they drink, they can just be drinking like they husband. We know that. They're that from the episode. The family is disorder. You should be drinking goddamn wine every goddamn night. I off the bitch.
Big shock. This person that I've always seen as the force of the family, vulnerable. Had a stroke? Yes. Now we're in the car together almost daily. I started to realize what can I pick up from my dad. He's been with Schwab for a long time. Jim, my financial consultant.
Yeah, the guys that have to get on, they just sit down and break it up about
them. I ever have makes a huge difference.
Trading at Schwab is powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights.
Some little motherfucker high 7%. He's actually kind of high. That's more stronger than a beer. The beer only 20%. The steel reserve is 10%. Well, like, that's pretty goddamn lit. That's why they call it. That shit pretty strong. And they both like to get fucking lit. The question is how that shit tastes though.
And welcome on this June 15th.
And then bottles, 6 bottles.
As always, Ms. Bottles. You have the Knicks congratulations.
Thank you very much. Yes, I am dressing appropriately.
Pretty incredible the game the last couple of weeks, and now we've got the World Cup. So a lot going on, but hey, we still got to talk markets. So let's do that. We'll make that as fun as we can. It's not necessarily the Knicks in 5, nor is it.
She ain't asking about nothing.
It's exciting to us, and hopefully it's exciting to our viewers as well. So let's do this. Let's go ahead. Disclosures. Today and every day, Lizanne and I are here to educate you and not here to provide personalized investment advice. And today is one of those days where we're going to get through a lot of your questions. So if you look over to the right of the screen, you'll see that there's a message box there, and Ben will be working the chats for us. So thank you, Ben, for helping us out today. Make sure you get your questions in. But just to give you a little bit of the lay of the land, we're going to cover some important weekly events here on the economic calendar. It's a 4-day week. Don't forget that. So Friday is Juneteenth, excuse me, and so markets will not be open. Will we be broadcasting any Schwab coaching content? So make sure if you do have option positions, remember that they do expire on Thursday. All right, Lizanne, let's talk about the calendar a little bit, because even though it's only a 4-day week, it's pretty packed in terms of maybe not economic.
So that's what you do, really. You fucking disassemble all your award scams.
We sure do, and it's going to be an interesting one. There's no expectation that the Fed is actually going to do anything, but given it's the first Fed meeting the press conference is probably going to be where the headlines are taken from. And what I'm paying attention to is, given what he has to some degree telegraphed recently, whether he makes any kind of definitive announcement about any change to the periodicity of the press conferences, whether he talks about maybe lessening the importance of or focus on or maybe eliminating altogether some combination of the dots plot and the summary of economic projections, his view on whether the Fed should consider alternative measures of inflation like trimmed mean versions, or whether he stair steps them out. No matter what he says, he's going to be peppered with questions. So I think the press conference is going to be much more interesting than
I mean, it seems like take a step back, right?
There it is.
It's still been kind of range bound. Maybe 4.6 in the high end.
I've been super lit with the friends. Now they all fucking got
in the middle right now.
Everybody lit now.
At this point, from what we've seen, when you look at the bond markets, kind of the way that they're kind of pricing in inflation, likelihood of maybe one raise at the end of the year. We do know that there are 4 at least right now. Do you think the bond market's going to be pricing in the potential that we might see more hawkish commentary going forward and what that could mean for rates?
Yeah, I think so, because to your point, Joe, you have had hawkish speakers out there. Because I actually had an interesting question posed to me at a client event last week.
You end up liking one, and then you're like, man, I'm going to get you.
It started with a statement.
I like that BlackBerry. go.
Warsh wants
That
lower
don't look
rates.
pretty good. Will
What the
affect me
market
out red
reaction
now.
would be if
The brand
he
Philippines, see, that's why I'm so strong. So they put liquor in there, and they have this. That mean they spiking it. Because ain't no way regular weed don't come at 7%. It's a strong ass wine.
He's or she's or some combination thereof to actually affect the move in rates. So that's why things like the press conference, where you'll actually hear from him.
I'm gonna go to the 5%,
Is if Warsh
I think they spiked it to give it that 2 more percent that way to get you lit. They getting lit now. Getting lit now.
If that were the case, and if that were the case, you know, at that point, he would be asked about it. So those are the things that I'm paying attention to. Credibly put forth a case for easier policy. I just
got some big bottles.
The drop in oil helps a little bit. But I think there's components, as we've seen, even with the strip out oil, and you look at the core CPI, it came in at 2.9%. But at the same time, you know, I've been looking at the PPI quite a bit as well too, because of the way that flows into the PPE. We're just going to get all of the syllables out that we can and try to come up with all the different letters out there. But
very good. Look at the white
have gone up, and we haven't seen the squeeze yet.
Great curation. I'm watching them.
6% up.
Realize, you know, man, we're going to post it within 30 minutes and probably so they'll make sure they give you a decent.
You know, one of the things that I've been watching when I look at
they give you a decent mover.
I do agree. I think the one thing that helps with oil prices coming down.
The phone's getting lit. And let me see what the
default switch right now is set to do nothing. And that would be what we anticipate, at least over the next couple of meetings, maybe 2 to 3 meetings. The data is going to dictate, and you will see market expectations flip around if you were to get outsized reports either on the inflation side of things or the labor market side of things.
Speaking of which, nice segue. Let's get into the labor market a little bit, because, you know, last week Kevin and I
look like it's made of
survey and how that's a little bit of a payroll survey. And why don't we start off? And one of the things that you and I for labor markets going forward.
Sure. So the Bureau of Labor Statistics, the BLS, does 2 different surveys each month. One's called the Establishment Survey, from which payrolls are generated. It is as it sounds. It's a survey of establishments. Which
big money. No, man. Give me some. Mecca Kingdom.
The birth-death model, which is not the birth and death of people, but the estimated birth and death of businesses. Part of the reason why payrolls will often send too rosy a picture when you're heading into an economic contraction is because of that
economic contraction.
You know,
goddamn, I don't think my accounts. I'm gonna fucking and I ain't gonna be stupid, but I'm down to kicking the wrong part of the wave and shit. And now they talk about economic contraction. I done put this fucking Charles Schwab shit on. I'm seeking knowledge and watching. But look at now we in a triple top. We on the fucking head and shoulder.
Is the survey from
the head and shoulder to the downside. Management inverse. That's we going down. And they thought he fucking had sealed the deal with Iran. They fucked those up.
Today we're looking at a level 42.
Right there, yeah. There you some wine. You need some fixing the ends off those spicy good.
That is an indicator for what you're eventually going to see in the payroll survey. So that was the one blemish on the most recent jobs report. But it may just be a blip, so it's too soon to say look out below.
Order it now. Don't take forever if you want to get it.
So I think another thing that's important too is looking at how some of the inputs are calculated, because you know, as you talk about the payrolls, it's basically like jobs created, but what we also know is that it could be people who are working multiple jobs. So if it's if they're carrying multiple jobs, if they're working part-time, how does that get differentiated? And when you're looking at that from a strategist standpoint, how do you look at that in terms of maybe, I don't want to say the value of the jobs, but at least the wages of the jobs, because these wages are not picking up in line with inflation.
Exactly. And that's why I think we're in an environment, Joe, where you have to look below the surface of just, especially labor market indicators. You have to look below just what the payroll number was and what the unemployment rate printed. Those are the two headline grabbers at the initial release. But not only is there a lot of meat on the bones below the surface, within that report that comes out every fourth Friday, but there's other labor market indicators and subcomponents that are important. So you mentioned working part-time for economic reasons. That's something to track. Duration of unemployment, how long people are staying unemployed. Labor force participation rate,
again.
wage story, average hourly earnings, both in nominal terms, which that data looks still fine, but in real terms, it's actually dipped into negative territory because, to your point, the inflation rate is higher than the growth rate in wages and in labor income. You can look at the differential between the U3 unemployment rate, which is the standard unemployment rate, and the U6, which does capture that working part-time for economic reasons. So there's lots of under the surface metrics. Then you have the job opening and labor turnover survey, the JOLT report. I'd say within that, a key indicator is the quits rate. The quits rate is the percentage of people voluntarily leaving their job. If that's a high number, that tends to suggest that individuals are confident in the labor market because they're voluntarily quitting. Job openings per unemployed people. So you want to look at the whole collection of labor market indicators and, frankly, inflation indicators, given that they represent the two sides of the Fed stool.
Really interesting question just came in from Nick. Is asking if you could maybe comment a little bit on the difference between some of the leading indicators that you follow, concurrent, and then maybe some of the lagging indicators that investors should be looking at.
Sure. So we have the formerly well-watched Index of Leading Economic Indicators, the LEI, that is put out by the Conference Board. It hasn't done a great job in quite some time in engaging potential weakness in the economy. And it's not really a problem on the part of the Conference Board, but the bias within the LEI is toward the manufacturing side of the economy, in addition to financial market indicators. So there's several financial market indicators, including the S&P 500, the yield spread, a leading credit index, which measures whether credit is tight or loose. I don't quibble with those at all, but most of the other economic indicators are for the manufacturing side of the economy. And that's not because it's idiots at the Conference Board that don't understand that services is a larger driver of the economy. But manufacturing does tend to lead the services part of the economy. What is sort of broken in that set of indicators has been the era, the post-pandemic era, where we really saw this disconnect occur, where you've had manufacturing in its own cycle, services in its own cycle. Until about 4 or 5 months ago, manufacturing was in a recession, but it didn't pull services down with it because services bounced out of the pandemic much later than manufacturing did. So we had these sort of separations where the up part of the cycle happened at different times and the down part of the cycle is happening at different times. So that's why you just don't hear folks talking about the LEI that much. The indicators within that, though, that I think are still of value would be things like the new orders components, not just of the ISM Manufacturing Index, because that is one of the leading indicator components, but also the leading index component of the services side of the economy. Initial unemployment claims is, I still think, a really key leading indicator. And back to sort of fine-tooth combing the labor market indicators that we were talking about before, another thing to keep an eye on is the differential between initial unemployment claims, which is a leading indicator, and continuing claims, which measures how many people that filed initially are still on unemployment insurance and continue to collect unemployment insurance. And we're seeing a widening gap there can sometimes be a tell on the economy. So those would just be some examples of of leading indicators, some of which do still sit in the LEI, but I would bring some of those services leading indicators in as well.
Is that's a 6 month between the initial and continuing claims? Is that the duration that they use for that?
Well, I think that there may be different rules per state as to when you're considered falling into that continuing claims, but that is one of those, and this has happened before on this show, that's one of those questions where I probably at some point knew the answer to. That's on my now to-do list, Joe. That's on, okay, refresh your memory, Lizanne. And
not trying to give you extra work, Lizanne. I know you got plenty
on your plate. That's, I can
find
that out very quickly.
All right. Okay. Before we get into some of the market indicators I wanted to look at, we'll get to one more question.
No way.
This is from Trade and Grow. What is the expected impact if Kevin Warsh restarts
look at the
reduction?
Double bottom.
So basically,
That's a double bottom formation. That means it's and that's a boom. You see, when you're looking at the baby market, it's which is a bear pattern.
Definitive announcement when you're starting this, shrinking of the balance sheet. We know that that's sort of his MO when he talks more broadly about maybe the reasoning and the need for a lower balance sheet, which would also potentially free up the ability to ease policy in short rates. But I think there's going to be a lot of discussion about that. So listen for any telegraphing of that, yes, but some immediate announcement, that would surprise me if that were to happen.
And you know that cattle, that's one of the biggest markets on the futures market is the live cattle.
Viewers always appreciate that.
And remember, live cattle was already climbing, and if now we have the shortage of the oil volume, it's
a decent level of support in the market. We tested it twice and bounced, and we got the news over the weekend that another steps have been taken towards a more understanding, right? Where Friday, hopefully this thing gets signed off.
Bigger companies, not just you thinking about small whatever brand beef, but what the Burger King and McDonald's and Granby say that we're working out and they can't risk their brand being the support inside the people.
Every time we get this dip, even though this one is the one that finally breaks the back of the buy the dip mentality, we still see investors coming in. There was this talk about whether or not money was getting pulled out of the
money that doesn't show anymore. You have to go over and using it for some of the different IPOs that are coming out in the future. What we continue to see, at least from a trading standpoint, is you continue to see a lot of positioning continues to be very bullish. That's just, kind of what they're holding in their portfolios from equity standpoint. Even something like Lizzie got some of the call positionings on the option side. Yeah, you're right. It's over 10,000%.
Skews. It's basically one of the things that I look at is 10% out of the money puts versus 10% out of the money calls. It's kind of the traditional way that we measure skew. And what tends to happen in a normal market is stocks are usually more in demand than calls. Why? Because people tend to be long stock and they want to protect the downside, so they buy puts and they sell the calls as a way to finance. So it almost creates like this shape, like a curve, right? Well, now you've got what we call these 10% out of the money price in terms of their implied volatility. And what that tends to tell me from people are willing to pay for this upside move. They've been right. I mean, yes, we've had pullbacks along the way, but it continues. When you see positions like that, and like I said, I can kind of speak from my experience in the options market, it tends to show that there is a little bit of this fear of missing out, but it's not like one of those signals where it's like, here's the point where things happen. It's more of a everybody's got a very similar trend. So if things do roll over, then it becomes a bit more of a cascading effect. Is that something you're kind of seeing from a sentiment perspective, maybe outside of the options market? Are you seeing that from client or or at least retail holdings, percentages of stocks in their portfolio? Like, what are you seeing that maybe a little bit different?
That money is so inspired by that. That's when my community had one period of work on the stuff, but I'm not in the case. Right, I'm going to tell you something. You can get back in
a deal in whatever form that takes. You're right to point out that it's just an MOU at this point, and we don't know the sticking points in terms of the actual specifics of the deal and how far apart the United States and Iran are on that. So TBD. But just in this most recent rally after a bit of volatility in the market, have you seen that retail dip buyer step back in the move off the late March lows? A lot of that move to more aggressive risk-on positioning was not driven by retail traders. It was driven by systematics and long-short hedge fund community and the commodity trading advisors. And for whatever reason, the retail trader just got a little bit more skittish. That's not the case now. And it may be some IPO-related enthusiasm that has kicked back in. But I do think we need to be mindful of that positioning.
It's only worth $200 because we were to sell it. That's
stretched on the risk-on side of things again, because that has somewhat like clockwork meant you get not necessarily a big pullback in the market or a major drawdown, but it does tend to kick in some of these rotations.
And it's already really characteristic of this kind of market environment. Just rotations that don't just happen from a sector-to-sector standpoint. That's how people get antsy. We got at least hold this for $100,000. That's what $2 is here
in the last few weeks. In sectors, particularly high sectors like technology, like communication services, where you see those rotations happening.
You don't want people to start jumping it in there even this year.
One of the key momentum trades is rotation, and so much money is playing sort of for that next rotation.
No, I would agree. You mentioned rotation within sectors, and you just take a look at hardware versus software. Software that has been a trade back and forth the last couple of months, where you could almost, like you said, as clockwork, see money going into one, it's coming out the other, vice versa. I was just looking at the number right now, so pardon me, I turn it over to the side. Just kind of looking at the breadth. It's really improved quite a bit over the last week or so. I remember, about a week and a half ago, we were looking at maybe 50% of the stocks above the 50 and 200 days. Now we're up upwards in the 60s. So that's helped. We're getting a little bit of a broadening of the rally. I think that's helpful. I think financials have participated quite a bit in that.
Equal weight hit a new high. Russell 2000 hit a new high. Russell 2000 pretty handily outperforming the S&P on a year-to-date basis. So there is a bit of a breadth story. I think right now 38% of the S&P's constituents have outperformed the index itself over the past month. That had gotten down into the low teens.
So that's a big jump from where it was.
Yeah, so it's still not a great reading, but certainly an improvement off the recent lows.
Yeah. We'll give you guys another minute or two. Questions in, but otherwise I'll just
that can run that can run business holdings in the whole firm. That's over 30,000 shares. That's my
CTAs. One of the things I would recommend for viewers here is to either Google that or we'll more education about that. I'll talk about that with some of our content creators, just to kind of understand
minus 18 cents. So $1.18. $8.20. That would make it better. If you go to $3.20, that's 90,000. If you go to $4, that's 100 grand.
They tend to look at those momentum opportunities for them to kind of ride it out for a while. So when you do start to see things like S&P 500 equity futures, to tell you that those CTAs are long those. And so those are some of the things that every Friday I tend to look at just to kind of see some of that positioning heading into the weekend. So I recommend people start to look at that as well. And then the other thing, Lizanne, is we publish our monthly stats.
You don't ever have to sleep if anything like I'm going to get you some leverage over that position. And go now really day trade with your E-Track. Remember that is also the point into the buying time.
on, and that's where you're seeing a little bit more stock replacement type strategy. So we're now measuring options activity within our stacks reports just to kind of see where some of the flow is heading. And what I've noticed is that over the last couple of weeks, even though there's been a decent amount of equity buying, there's been another trade that is kind of really kind of moved to the forefront. And this is it's an idea of clients are actually looking to kind of maybe sell premium, whether it's calls or puts, as a way to participate in some of these moves when they start to see volatility really start to pick up. So we've been seeing a decent amount of puts on. So this is different ways that our kind of educated clients are participating in different moves buying equities. We're seeing a lot more ETF activity. There's definitely
ETFs represent more higher share of trading volume on a daily basis than individual stocks now.
I remember the first equity ETFs really started to come out, and we started looking at the options activity on those, and they were just a handful of maybe some of the more diversified ETFs, but now with the doubles and the triples and the stock-related ETFs, there is just a myriad. And I guess the one thing I would just kind of bring to the awareness of is if you're in a trade, understand how they're constructed, those ETPs, understand how they're constructed, how they rebalance many times overnight, in order for them to keep that double and triple leverage. So just be mindful of that. Looks like we got one more question here. Does retail joining months after institutions tell you history? That's from Barbara. I don't know if it's months, but maybe weeks.
No, I think it was for whatever reason just some solutions that kicked in after the low in March that just there was just more reticence on the part of the retail trader. They've otherwise they've kind of nailed this for several years. So they're back. I think it was not the beginning of some new trend. I think it was just kind of war related. And
like you said, part of it is trimming gains, right? I mean, part of it is just risk management. When retail did lead the charge back in 2025 when they were the first cohorts to really kind of buying. I think we've gotten a little bit, I don't know, right or wrong, but we've gotten a little bit accustomed to some of the volatility based upon some of the different fiscal decisions that are being made out there, and we trade off of it, right or wrong. But I mean, that's kind of what that's been the pattern that we're seeing.
Yep.
Well, Liz Ann, another pattern that I can say is that you're always providing insights, so we appreciate that. Congrats to you and your Knicks and that color orange. Well.
Thank you.
And we'll hope to talk to you again next week. So thanks again. Bye, everybody.
Bye, everybody.
Hey, investors, you know the market moves. And Schwab is here to help you move with it. So, whether you're buying, selling, holding, or planning, whether you're ETFing or 401k'ing, saving, spending, or even retiring, you can count on Schwab for market insights, live support, powerful trading platforms,
We want you to pay $3 extra for direct to you.
so you can invest your money. Sounds nice, right?
I'm ladies live at the New York Stock Exchange, and this is the Watch List. Your midday view into the trends driving the market with a sharp focus on technology, innovation, and companies leading the next wave of growth. Big movers, real-time interviews, and insight from analysts, founders, and market voices you trust. The Watch List, 2 p.m. Eastern, only on Schwab Network. Real-time access, data-driven analysis from U.S. equities to global macro matters. Schwab Network connects the dots. Watch live, subscribe free at
TikTok motivate the data to move quickly and accept your order. Yeah.
So what is unique about Schwab coaching is that
you can just see and feel all the excitement around the topic.
Some of you want to get everything face-to-face with you and 400 or 500 participants. Some clients like to be in the privacy of their own home on an online workshop, but still having live interaction.
As I'm talking, questions are coming in from that live audience. Help me fill in those gaps as educators. People learn differently, but all
all those ways we actually teach it all come back to the point of making a difference and helping you make progress.
And so that means not just giving you theory, it means giving you the practical implementation using our platform.
Yeah,
So we want it to be fun, we want it to be informative, and most of all, we want you to walk away with a skill set and independently be successful in achieving your goals.
Stay connected to what moves markets. Download the Smart Network app and get live coverage wherever you are.
That's more important. That's a good move when you do the trade. I got it.
That's when markets make headlines and traders make decisions. From great shocks to rotations, we're tracking the catalysts that move markets right into the close.
Here on the floor, I bring you real-time sentiment from traders driving the action.
And in Chicago, we break down the data, technicals, and trades you need to see before the bell rings.
Live coverage at the close every single day. More and more on this. And then that's why Iran was so important. It's not just about them oil they keep talking about. Well, it's clean the oil, but the oil creates the byproduct, which is what makes the fertilizer. So in order to fertilize your crops, you need phosphorus and potassium and nitrogen, which is the byproducts of oil creating gasoline. So they need to the base of the principle. It covers the coming point. So some of all the I know that the phosphorus of the producing chemically the byproduct of making gasoline. Gasoline, you get crude oil, you get diesel, and you get the fuel left on it. They use that and that's when you get the producing nitrate, the nitrates. The nitrate is what you spray over the crop. Or it won't grow, but that then will do it. So what nitrate is going to grow? People aren't even fertilizing, but I've been pushing it for now.
On Wall Street, you are looking at an S&P 500
And so you talking about trying to feed a population, and if you want to do it, you go to move around that, but you talking about you need 100 metric tons of wheat, whatever to feed them 100 tons of flour. This shit got to work. They need, or people going to starve and you going to have famine. And if he's looking at these weather conditions, most of these places, there's no way to be able to predict.
That stock's been gaining ground today.
Or any company makes less than whatever amount of rainfall that you do. These are not business or just one of the rejecting companies.
Try to read the tea leaves on headlines.
It's rain. You don't get under a 34%. No rain makes the desert. You don't, whatever, less than 3 inches per year or whatever is a desert.
All right, guys. So we got Wall Street trading. Sideways today. It does. I mean, we've got still some momentum, even though we know we're bracing for the conclusion of the meeting. It's not about where rates go because we kind of have a certain expectation there. But what does new Fed Chair Kevin Warsh telegraph from here? This is his first meeting as Fed. His first meeting, obviously. He's been on the Fed before. But Tom, what's your take about how the market is perceiving and preparation for the end result today?
Yeah, Diane, he hasn't been on the Fed for over 10 years. I believe it's been 14 years. So a lot of things have changed. He had COVID come in. So, I think if you take a look at maybe the dot plots, the summary of economic projections that are supposed to be released, he probably won't provide a dot. He's previously stated that giving guidance on these dots isn't, something that the Fed should do at this point. So maybe he has a discussion with the
Even now, I then got me learning how to say that shit. Back you can see, I only learned the lesson this year.
The SEP that's coming out on a quarterly basis. So maybe some guidance there. One of the caveats that maybe he'll discuss is the balance sheet, right? What if he, pivots and says, hey, we need to start shrinking this balance sheet a little bit? That might throw some volatility into markets, but we've seen some consolidation in yields here.
It's hilarious. They didn't expect the maneuver. They call it white business fail. What is this?
Still out there spending.
Another one of your little women products. Oh my God! So you can hook yourself on the other one with a tool.
As far as the geopolitical tensions here and signing that MOU.
that might be a benefit. But I think there might be some volatility this afternoon just due to the fact that this is a regime change.
In fact, they didn't really
Type of narrative
they came on that and he
is
took
going to have in his discussions and press conference at this point.
And now
Because
I was like,
I believe there's going to be maybe some hard questions finally from
and then the
some of
long
the
lashes
media
come from prostitutes when they just come on their face. That's what they come and give it to their eyes, so they do long lashes.
That being said, we're starting to solidify up here a little bit. S&P is relatively flat. NASDAQ higher with guys, check this out, all 7 of the Mag 7 names are in the red right now, and we're still positive.
You think you slept in makeup, didn't you? I'm not like your forehead look like that.
But Kevin, your take when you look broadly across the market for the conclusion of the Fed meeting today.
Oh my God, look at that makeup dude. That's the window.
The first thing that jumps out
That shit dry your shit out. All the damn products, bro.
Yesterday in the S&P 500.
And then they got a young bitch next to her, and that young bitch next to her. Let me fucking scamming women. They be fucking scamming them ladies. They would be like,
the leadership
you fucking turned everything down the top. You think all the food top to get you
nothing to do with what's going to happen the rest of the day. Kevin Marsh, how he's going to come out. Is he going to come out like
that blotchy white ass skin? No wonder they don't like black people.
Changes in policy, and like Tom said, there's a new leadership.
My shit all pale and pale ale and blotchy and pink all shining blue.
The balance sheet and communication.
Look like a piece of paper and shit.
And then here's something that we didn't think
remember that movie saw where they put the tan or whatever it was?
In this Fed meeting. Is he
everybody can put the tan now?
Some type of Fed meeting? I don't think so. But you never know. He made dissent. We don't know what's going to happen. So I think there's a lot of chances for people to
what the hell kind of
change
tan
and look
is this?
around.
We get a set up tan.
2:30 Eastern time is must-see TV for these markets because the markets could get really thin and wicky
draw on their face.
There's so much unknown about what
man, look at all that shit when you put that whole damn fucking senator on.
In his first press
conference. They just tell me maybe you could be a decent young lady. I don't see why.
Something just dropped down here.
You ladies are work on the food thing. I'm going to take a chance and it's going to get rid of my fat. I don't want to go through the
agreement between the U.S. and Iran.
You got me all bitch.
The two sides are discussing moving up and signing this MOU. When I saw Wednesday, I was like, wait, we're at Wednesday right now. Tom, your take when you think about where things stand on that front.
And maybe additional volatility over the next couple of days if that comes to fruition. Now, it's not a report on Axios. Who knows if it's true or not. If you look at the 14-point MOU that they've stated, Bloomberg reportedly came out with something. Iran, their news outlet basically kind of pushed back against it. It's not accurate. So that rhetoric continues about what he said, what she said, what the two sides have come to any type of agreement on some of the aspects within this memorandum of understanding between the two. But, you know, President Trump came out and said, hey, this is just an agreement. And then we started getting into really in-depth discussions. We're going to go back to dropping bombs on Iran. So there's still that caveat out there for markets here.
But they don't tell the young girl you don't end up looking like that old bitch. This is little next situation. Did you scare you, bitch?
So,
here, you wake up late at night,
markets. I think that's one of the questions that traders and investors have to take a look at. But I just expect some volatility not only between what's coming out of the Fed, but maybe maybe his deal getting signed. But is Israel on board completely?
She got that. She got bill problems.
Flying over the straits.
Also, you
So yeah, there's a lot of
situation
minutia the geopolitical risks and the headlines that might come out over the next,
that's what that shit you put on your face. They got hormones in it to turn you into a man.
Is Israel on board? Though it sounds like in terms of the U.S. side that they're very clear on where they stand and want things to move forward as it stands with the MOU. Again, we're still waiting for some of the text. We've seen some Bloomberg reporting where they've seen some of the text. Kevin, your take when you think about what the latest and how you're dissecting the headlines on the geopolitical front between U.S. and Iran.
The free cricket to that state. No, damn, man.
I think the headlines that President Trump made this morning were just.
It's not the other way around. So when it turned into me, remember that everybody starts talking to
he says this is not perfect.
You turn into you.
We're going to go back to bombing. And remember, let's realize something. We're talking about a regime, a country that wakes up every day
then they
and
put all that
says,
black shit on her because her skin is whatever. She need to go get a tan.
I don't think that's going to change anytime soon. And so even though we're pressuring them into a deal because
you ain't trying to see that damn nigger.
it doesn't mean it's going to change the way they think about this country.
That's crazy. They made her darker. They haven't been noticing that. They've been darker than us. Because they ain't got no more black people no more. So they ain't got more black face on the black face. They are darker. Because look how she looks really now.
It's not going to be smooth. And I think there's still
risks out there. So that means she wears a lot of makeup on her face. And her breath, that's one of her face everything fan. She wears fucking makeup and cover it. They put her focus on the face.
2 or 3 CPI data numbers that showed energy jumping.
And they trying to get that shit on her pretend with a fucking napkin.
They're going to keep crashing down that inflation. So it's good news for inflation. Kevin Warsh, lower interest rates than a couple weeks ago and lower crude oil than a couple weeks ago.
And now you got 2 different fucking big brush heads.
About a month ago.
Oh my God, I keep painting that shit off. It's a damn paintbrush. Mole hair, better be mole hair.
Diane.
Wow.
That's what it's supposed to be. Long hair brush.
Right now,
Don't do that no more. You'll fuck. That's just synthetic fiber.
What Tom just said, and this is what we saw earlier, where he said, if things don't proceed in terms of Iran's side, that the U.S. quote will go right back to dropping bombs. It is a memorandum of understanding. There is obviously some sharp language on the side of the president. The signing of the MOU would extend the ceasefire for 60 days and set up that framework for future negotiations.
That's the first time. They'll show you it now.
President Trump currently speaking. And let's get into one stock that's on the move. Broadcom shares gaining ground today over the analyst which says the market continues to underestimate Broadcom's quote significant dominance in packaging design, cadence of new designs, and its intellectual property portfolio. Tom, your take when you look across Broadcom?
Yeah, before this nice over 5% pop that we're seeing here today, the stock was in bear market territory, now down about 19% from those all-time highs prior to earnings. And the earnings were great, guys. And the caveat was that the guidance was lighter than what the whisper numbers and maybe the
blush that bitch, put some pink on the maneuver. Give her a little pink. It's crazy. They use makeup to cover with the pink and then go put more pink back on their face. They just don't rub it in and give it some natural look, make it look natural.
Started selling off the stock. Now the stock ran into those expectations of that.
When you go sad, now it's starting to put a little pink back in the pink.
Was sitting at all-time highs. This typically happens to it. They kept their $580 price target. They seem to be aggressive buyers at current levels. If you listen to hyperscalers and the broadening out of what a lot of these tech companies are doing as far as these special integrated chips that maybe aren't GPUs and the demand in that space, that hey, maybe the outlook's better than what the CEO gave at this point. Pretty hefty price target here on Broadcom. We did see a recent price target hikes on Broadcom, some of the semiconductor makers, KLAC, Lam Research, AMAT also today, ARM Holdings.
Then it won't matter how you look. Somebody will love the inside of you for you.
In the tech space,
you can be handicapped missing the arm, people still love you because they love you. Not how you look during the daytime and then you look like a totally different beast.
analysts and media, and they constantly get it wrong. Right? I mean, this is a JP Morgan analyst coming out and saying that some of these reports about a breakdown with Google and Broadcom are not true. And I don't remember in my career as much speculation that comes out inaccurate as before. This little sector of the U.S. economy with NVIDIA, Broadcom, AMD. AMD's a little bit of an exception.
It's gonna forget the foundation ball. Double 10 and it gets some lips get then it comes to the Asian light.
Now, Broadcom's catching one today.
Yeah, I mean, you mean that's Latina, they get the foundation. That's what they put when they say on the bottom 10, black and
only time will tell if it is too good to be true, Diane.
Only time will tell. We'll see. Shares of Broadcom rallying 5.5% right now. So it has some momentum today. Let's look at the flip of that momentum. SpaceX, they're coming back down to earth after a meteoric run since its
look at all the damn brushes. I don't hear no holes skin. They ain't no fucking hair.
That we've seen, you know, the big gains that we saw out the gate, that nearly 20% move that we saw in its first full day of trading, and then further momentum. But now it's like we're seeing a little bit of flagging now. Tom, your take when you look across SpaceX?
Yeah, not surprising that we're seeing a little bit of a pullback here. It's only, what, 3% pullback as of right now, just above $195 a share. But one of the more interesting things is, you know, options for trading yesterday, 1.7 million contracts.
And then you got the big ones where you just want large applications, you know.
Tech names, just below Tesla and NVIDIA. But today, you're seeing more of a balance between call and put volume. Call volume's about 474,000 calls traded today. Put volume about 465,000 puts, so almost equivalent at this point in time. So maybe some people created some hedges at this point. Weekly options start trading tomorrow in SpaceX, so that might
you stick your face in this thing and poke your eyes and then
more because they're only trading monthly options now. But you know, it's not surprising to see a little bit of a pullback after that. You know,
the fucking goddamn face 5,000.
So yeah. You know, this is going to be one of those volatile names. We talk about Tesla this way, and we have for years. The beta that's in this name. SpaceX, because of the valuation levels, the hype around it, the global interest in this stock, I would expect beta to remain pretty elevated in this name, at least in the near term, if not the long term.
Great point, and you wonder if this will be one of those things that ends up being like Tesla, where you have very strong points on one side, very strong
yeah, see, right there, little tight zone, little tiny nose.
points of view,
And then, you know, the eyelids. And then you got the big baggy, and it's a female color.
Bull versus bear coming up. The guys will get their example trades put together for Intel. That one's powered up today. We'll have more fast market after this break.
These days of women have zero dexterity. About the stupid bags.
Intern, this place is incredible. It's where I get all your office supplies. Your fancy coffee, your giant TV. It's everything in one place. It's like Schwab. Everything investors need. Come again? Yeah, at Schwab, they can do everything. Invest, trade, get full service wealth management, and anything in between. I think I'm going to be sick.
Max out of bag.
Invest your way with Schwab.
Same goes for where you invest. Level up and invest smarter with Schwab.
I'm Jenny Horn. We go beyond the headlines, tracking the trends, sector moves, and fundamentals shaping the markets in real time. This is Schwab Network. Subscribe at schwabnetwork.com.
Real-time access, data-driven analysis from U.S. equities to global macro matters. Schwab Network connects the dots. Watch live, subscribe free at schwabnetwork.com.
It's so expensive, man. But you know, Levinson back on the
Sometimes, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Morning movers brings traders the biggest headlines to start the day, from volatile overnight swings to the earliest analyst calls. Get your watch list ready. 8 a.m. Eastern, Morning Movers, only on Schwab Network.
Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
Welcome back to Fast Market here on Schwab Network. Intel back in focus after announcing that its next generation 18AP manufacturing process has entered initial production. This is an important step in the company's effort to reclaim its leadership in chip making. Think of 18AP as an upgraded blueprint for building faster, more efficient chips, both for Intel's own products and for outside customers. The update is especially significant because Intel is trying to grow its foundry business and compete more directly with industry leader TSMC. Reports that Google and NVIDIA use Intel to manufacture future chips. That's boosted investor optimism. Now, with AI driving massive demand for compute, Wall Street expects Intel's data center AI business to grow 40% year-over-year this quarter. All right, time now for the tug of war on Intel. For that, let's welcome back our co-hosts Tom White and Kevin Hinks. It is bull versus bear time. So before we get to your example, we're going to get each of your thoughts on Intel. This talk has continued to travel higher. Kevin, I'll start with you. Your take.
Well, I look at Intel and I see the one-year chart showing a low of 1897 was their low. It looks like the rally is about 460%. Obviously, the United States government has a $8.9 billion stake in NVIDIA, has a stake of about 4%. Both of them have stock around the stock. The optimism, Diane Towns, is getting a bit expensive, right? It's Neiman Marcus optimism that we have right now in Intel. And I think they need a lot of good news just to keep the stock where it is right now. And so, yes, I believe that Intel is now safer than it's been. I just don't know how much of this good news is priced in and how much the stock has run past its value. So I'm very wary of how long this stock has run. They've got good news coming up. Is it good enough to keep the stock right here? I have no idea, Tom and Diane.
When I walked into a Neiman Marcus before, I loved that analogy. I was like, oh, it just feels like a museum. I'm like, I can't touch this stuff. I don't want to break anything here. Tom, your take when you think about Intel?
Yeah, Kevin mentioned it. It's valuation. It's on the forward PE over the next 12 months. It's 100 times multiple. It's a lot more expensive on a valuation basis than AMD, and especially NVIDIA, which, by the way, just turned positive on this session. But Intel coming out with this new chip, maybe trying to Intel, NVIDIA, they've invested $5 billion in Intel, nearly 10% stake the government took. SoftBank invested $2.5 billion in the company. So there's been a lot of underlying positive tones for this company, but they're still losing money on their foundry business at this point. But this is
but they didn't have to do that at all because it was eyebrow and not no man ever in the history of me. Everyone was like, I would have supported y'all, but the crowd.
CPU pricing has gone through the roof. Demand is skyrocketed at this point. Now they, according to Mercury Research, they own about 67% of the CPU market at this point. But AMD is digging into that. Because just 4 years ago, that first quarter of 4 years ago, they had 88% market share. And now, big brother NVIDIA is getting into the CPU market. So valuations really elevated.
But they don't do it with shit like that, though. They do it with a car or things like that. I'm with golfing. It's a status symbol. And women don't have any status symbols, so they go and totally go in the wrong direction. You're scary, too. And you got them jumping in his teeth.
Kevin, let's start out with you. What's your
Fuck
approach
ass
today?
team, you gonna bust with Gary, weird ass white woman. You saw with that fuck ass teeth. Look at you, you grew up. Oh, it's over for you, girl.
All right, and we've seen that. There's often
And they got these weird ass dilated ass people.
and then the actual numbers. So
Which is weird as fuck, bro. There are people that look like that. They on drugs.
June 26th.
Something, bro.
$14, I rounded that
People, those are called dilated people. They're people that don't dilate. They contract underneath life.
So for $2.05 is what I put in there. I'm
People
buying the
die.
July 10th 105 put and selling the June 26th 105 put.
Oh my God.
With my strike selection, and Tom,
You're gonna do a little tearing it down. I'm gonna get the young money. The young money is gonna be just barely just that beautiful.
Just a 4.5 Vega, Tom. So something where I get directional P&L. I can also get long Vega P&L, Tom.
You said being young and beautiful. Why you think you look like that for over a year?
And it may not
Yeah, let's break this one down. 23 days expiration coming out to the July weekly option.
The next one keep popping. And they come in flavor.
26th weekly.
Because you can't put it on the stuff you have to wipe off the shit. You can't get the grease stuff.
It apexes out as far as
Go.
at or near the strike that you're doing the calendar on, so it gives you that downside exposure. So you've got a nice wide range for this stock to trade in to be potentially profitable. While 105 is the area you want it to go to, if it trades 110, 100, that's still in the profitability range here. You've probably got a range of about $95 on the downside, maybe 117, 118 on the upside. And Kev's trade is 2 weeks wide, right? So you have that opportunity of weekly options, and those are over $3.50 on at the money puts right now. So if this stock does fall down towards 105, those credits that you can collect on these adjustments really start to explode. That takes a lot of the risk, maybe all the risk on it, depending on where the stock is and volatility levels. And that downside exposure, if Intel starts to fall a little bit, we'll see volatility expand. And because this is a long Vega trade, as Kevin mentioned, this will expand the price of that calendar also. So that the double bang for your buck here, where, hey, if it goes lower, it's going towards where you want it to, towards 105. But then also, if you see a spike in volatility, that might expand that price also. So giving yourself that downside exposure on this one. Kevin, I looked at something a little bit different here that is a little bit more passive, but it's capital intensive, because I looked at a cash secured put here, and I went out shorter term, just to the July 2nd weekly options, and looked at the selling the 110 strike put here. There's a cash secured put. The credit you collect is what you can make on this trade. $350 per spread. If you collect a $350 credit on the put that you sell on the 110 strike, July 2nd weekly options, it takes your break even down to 106.50 to the downside. Now, I mentioned that capital intensive, right? Because you've got a lot of risk all the way down to zero if the stock will somehow go there. Not out of the realm possibility, but not probability that it will. But your max loss about $10,650 if it did go to zero for some reason. So, Kevin, looking at this type of trade, it's a little bit more passive. I've got a cushion to the downside break even here. You got to be comfortable owning the shares. But at the same time, if you think like, hey, I wouldn't mind buying the shares if the stock does fall from these elevated levels. And
you see right there, he said, I wouldn't mind buying the stock if it falls from these elevated levels.
Strike, You're still going to be profitable in this type of trade.
They want to correct it. And then you showed it on the thing. They showed it. It went up, and it went down, and it went up, but the same one is now lower than the middle one, which was higher than the first one. So now it's a head and shoulders.
Gives you $10 in cushion, $10, $11 in cushion, where you can go down
Which is basically a triple top. But it's really called a head and shoulders, and you got a hand in the middle and then two shoulders.
You can do one of two things. You can
Now the price is definitely going to
right? And your break even would be what, 106.
So that's what I'm not even fucking this weight. Even I'm doing
market lets you, or you
not
can
even trade because I'm not taking only going into a correction.
This is one that has, it's collecting
I
data.
got people with
Risk down to zero, just like a COVID strategy has risk down to zero. But it's time. The great thing about this trade is you don't enter at 110, you enter at 106.50.
I'm going to be taking it to this one for the time. Because they be really doing quick. And they got other people to get in line with all the other people's speed.
Yeah. And they got some trick in now.
Yeah, that's it. The box.
But you've got to be prepared for there's your gold bear debate.
Tomorrow morning. Stay right here on Schwab Network. Fast Market will be right back.
I'm Sam Barnes, live from the New York Stock Exchange. When the market moves, we're on it. Getting the reactions, the strategy, and sentiment in real time. Stream Schwab Network at schwabnetwork.com.
Shut down.
Trading at Schwab is powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform.
My parents didn't really talk about money at all. In college, everybody around me had money. I didn't want anybody to find out that I wasn't middle class. I was using credit cards to do anything.
What happened to your John with the wind? Because it's down by now.
That's when I kind of realized, like, all right, I have a money problem. This is about how my finances got wrecked. I could do that. You can do it too.
Just the market, from open to close and beyond. Streaming 24/7, any screen, anywhere at schwabnetwork.com.
Until I got to have one.
Schwab has been with us for almost 25 years through purchasing of houses, opening up our business, having children. They've always been there for us.
I want to invest in a company that can help me give my
I had 94%. Man, everybody lives around 90%. Automatically start taking it. Yeah.
Welcome back to Fast Market here on the Schwab Network. I'm Diane King alongside Tom White in our Chicago studio. Time now for our cash tag segment. For that, let's bring in our next guest, and that is Andy Swan, co-founder of Lifefolio, joining us today to take a look at
Money closes the fucking door. We gotta see that video, that man, the man was written all by that truck. We'll stand that damn thing in his hand.
So not a great year, not the worst year. What does sentiment look like now from you guys' point of view, Andy?
Well, this is the most negative.
Go close to that, go lean it back. Kiss the nigga or Petey. Get a little Petey.
31 to negative 5.
Like a little
last few quarters. The reason in the Lifefolio demand orders just and a pretty steady steady downtrend to take the seasonality out of it. And then the big factor, I think, the big kind of yellow flag, red flag for me is when we look at Kroger compared to peers. You've got Dollar General up 20%, Instacart up 19%, Costco up 9%, Walmart and Amazon are positive, and Kroger is negative. And I have a feeling
they was in there now. That thing was scam. Look, I'm floating. I'm floating. Are you floating?
Dominating Kroger in every market that I've seen it go.
Now we're in the modern time.
Turnaround story that they want to tell, but the demand data that we see on our side and in real life, talking with friends and family, Kroger is it's a very difficult story to turn around.
Yeah, Andy, that kind of fed into my question. You mentioned the farther below the stock. The stock's pulled back 19% from those all-time highs.
And she's kicking around in 2000s. Make sure you ain't got no children in there.
Built into the shares on this nearly, bear market pullback that we see.
Yeah, you would like to think so, but I don't think that's happening yet. We continue to see a continued decline in our data that has been very consistent over the past year, quarter after quarter. The stock price has reflected that nicely. We don't see any signs of a turnaround, and we don't think necessarily that the stock market has fully caught up to the negative cycle and the negative feedback cycle that the Kroger customer is in right now, and the alternatives that they're finding. Once you switch grocery stores that your family uses, it's very difficult to get people to switch back. And so, we saw that with Target the last few years as well. Not on the grocery side, but on the retail side. So this is a tough story. And
This shit is like so ahead
a lot
of
of times we see stocks act like this, and they become a little PE ratios get compelling and low. But when the business itself and consumer demand are constantly decaying, then those low valuations tend to become value traps, and that's what we think we're seeing with Kroger right now.
So do you think that there is a shift? Because when you look at your chart, consumer demand is very strong over at Dollar General, Instacart, and Costco and Walmart outstripping, but not to the same degree when you think about Dollar General and Instacart there. So is that the Kroger customer moving over to these names instead? Is that what's happening there?
Yeah, I think so. And just from personal experience, I talk to friends and family. When we got our first Publix here in Louisville, people went in there and they were like, this is the Chick-fil-A of grocery stores compared to going to Kroger, which feels like the drive-thru at Wendy's, and it's a terrible experience. The analogy that I started hearing, and people are driving to Kroger stores to get to Publix, one of the Publix in town. So I think that this is a common theme. So people that are trading down
Why they got their own thing? People talk to people that's going to that's
They got in a really tough spot. I think they've got a new CEO. He's from Walmart. He's probably the right person, but it's still a very difficult job. It's going to take some significant time to get a real turnaround for this company.
Andy, do you guys have any data about people, in this inflationary period that we've been in, especially with crude oil prices? We've finally seen a crack there over the last couple of weeks here. On the consumer, where people aren't going out to eat as much, cooking more at home, because that could actually provide a little more a name like Kroger, right?
An enemy has been slain.
Yeah, and it's kind of weird because our data says the exact opposite. That people they're door dashing a lot more. They're eating out a lot more. They're relying on the grocery a little bit less, which is counterintuitive. But I think it kind of comes down to the point of this is one of those experiences that people want to keep. They might give up, the $700 lease on a new car and instead keep their, entertainment and eating out type of stuff. They might cancel the Caribbean cruise, but they keep some of life's little daily pleasures intact. So that's the theme that we're seeing here. It's not. I don't think that the consumer is, in terrible shape, but the ones that are having a little bit of a tough time, they are trading down to, eating at home and going to Kroger. They're finding other ways to save their money. Yeah, we're negative 25, which is slightly bearish, and we think the Kroger turnaround story, the outlook on the turnaround story could be a catalyst. So there's some risk in a bearish trend, but we do think Kroger.
It's the only one that pairs for life, but it's the way and keep it on. It's starting now, it's $79.
Let's get Kevin back into the phone. Tom, insight from my portfolio team. Your thoughts before the
Yeah, this is a pretty dour setup from the portfolio data. I thought this pullback in the shares might, actually improve maybe their outlook for this stock.
There is no greater tragedy for a parent.
He died when that doesn't look as far as the multiple goes. So it's not overly priced, but it seems like that data that
they must have died in that car ride. Did they feel that or not?
This year, but Kevin, looking at this name, stocks, the option market price about a $2.80 move in either direction.
You're right, Tom. Like Folio's data is really representing what CEOs
We're in custody?
But make no mistake, Kroger has 1,250 flagship stores, and they control a total of 2,800 stores in 35 states. So they're going to work that combination or that relationship between lowering prices and margins. And so when I looked at Tom, because a new CEO, because they could have some relief or some good message, I looked at something in the call calendar family, and I looked at the buying the June 26th, selling the June 18th call calendar that was trading about a quarter. It's trading about.
I thought he was a pedo. Happy he was a pedo. He was relieved. I thought he was a pedo. And now it's adorable. Big thinking that grandpa was a pedo.
A 58 or 57 or 56 put calendar as well, Tom, but a very inexpensive way to play a directional move in Kroger, because the front expiration is trading about a 107 and the June 26th is trading about a 48 implied value, Tom. So big dispersion there between the two implied values.
As Kevin mentioned, if you're bearish, you wouldn't do the call calendar. Maybe you would look at a put calendar. But this is really short positioning that Kevin came with. 26th weekly option buying that 66 strike call. That's 9 days to expiration. And then in the near-term options that expire on the 18th tomorrow, sell that same 66 strike call. Debit, there's your risk, $25 per spread to get some exposure to the upside. Now you can break even. You want to move at your 66, between maybe 62 and a half, maybe 69. The upside could be potential profitability on this way, this type of trade. I haven't mentioned that follow dispersion lowers lowers the entry point price, and that lowers your risk on this trade. You've got some assignment risk on that short call going into expiration.
I guess they need some
26 hours or so. So keep that in mind on this one. But an inexpensive way to get some directional bias. Now, if you're more bearish, I just looked at the 1 week wide 58 put calendar on this. If that sets up with like Folio's data, that'll cost you about 30 cents to do a 1 week wide put calendar, and that would give you exposure to the downside. And Diane, if you don't have a preference on whether it's going to go higher or lower, you just want it to move about that one standard deviation that the option market's priced in, $3 in either direction, then you can do a double calendar, just combine them both. But Kevin's example here to the upside, low risk exposure with that call calendar.
Did that one, Kevin took this ended up being a bull bear debate essentially because you're taking into account that like folio data and adjusting if you are bearish for this example trade. Thanks, guys. We've got the breakdown coming up. Join us. Microsoft after reports had walked away from a $3 billion Oracle deal, only for Oracle to deny that report. That's next on Fast Market.
Stay connected to the
how about it?
Schwab Network. Tune in 24 hours a day, 7 days a week on schwabnetwork.com and on all your favorite streaming services. Schwab Network, available anytime, anywhere, on any device for free.
Hey, Pop. Hey, Andrew. Last year, my dad had a stroke. Big shock to see this person that I've always seen as a force in our family be vulnerable. Wait, had a stroke? Yes. Now we're in the car together almost daily. I started to realize, what can I pick up from my dad? For a long time.
Jim, my financial consultant. I probably met 20 years ago.
Jim's really been there to answer any questions I ever have. Makes a huge difference when you have someone that actually cares.
Hi, I'm Alex.
I'm Jane.
And I'm his mom.
Sometimes you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Talking robots, playing with them.
Instant reactions, earnings breakdowns, and hot takes that teach you about stocks and markets. Follow me on X at
When I know it's just a computer chip or something, but sometimes the way it's featured, it seems as if it's alive.
That's in your definition of alive.
Serious.
Oh, she's got your smile. Carl.
It's nice to meet you.
Brokers here to welcome you.
Actually, we invest with Schwab now. We have everything we need all in one place.
I was calling it something called alarm.
Trading strategies.
And Schwab helps me generate retirement income.
All this Schwab is everything you need is making me cranky.
Does somebody need a nap?
The neural patterns from
Invest your way with Schwab. Stay connected to what moves the markets. Download the Schwab Network app and stream anytime wherever you are.
All the messages of a looking life. Fortunately, the technology failed.
Welcome back to Fast Market here on Schwab Network. Diane all live on the floor of the big board. Before we get to the breakdown, let me give you a check of where markets stand as we get closer to the bottom of the lunch hour on Wall Street and closer to the end of this latest Fed meeting. Chair Kevin Warsh's first meeting as the head of the Fed. The S&P 500, little change right now. We are flat, up by less than 1/10%. The Dow has a gain. We are better by more than 1/3%. So similar price action to what we saw earlier in the hour. NASDAQ 100 also better by 0.4%. The Russell 2000 higher by more than 1%. Investors also continuing to try to read the tea leaves on the rates between the U.S. and Iran. We've seen a report Axios that we may be signing
brain swap and did a neural connection into the robot.
Understanding between the U.S. and Iran will come on Friday. We'll continue to bring those headlines as we get them. Time now to bring down the competing headlines hanging over Microsoft today. That stock was initially dinged after a report from Business Insider said that the company walked away from a $3 billion deal to lease Oracle cloud capacity over security concerns. Oracle hit back to that report via Reuters, saying that report failed Microsoft cloud talks are inaccurate. An Oracle spokesperson said, quote, Microsoft is both an OCI partner and a customer. We have a tremendously collaborative and fruitful partnership partnership where we often talk about ways we can expand upon our ongoing work together, end quote. Still, shares of Microsoft are under pressure. It's down more than 2% now. Stock has fallen about 20% on the year. Time now for the breakdown for that. Let's welcome in George Silla, senior markets correspondent, to take a look at Microsoft today. So even though you've got competing headlines where Oracle's trying to push back, it feels very he said, she said. The market seems to be paying more attention to this Business Insider headline. How do you make sense of the price action, George? How do you break this one down?
Well, I mean, this is interesting because, you know, for all intents and purposes, if you look at things like valuation on Microsoft or even analyst ratings, the mid-target rating for Microsoft is around 60, the high target around 160,
and they look at a damn push cat. You didn't
so something's amiss with Microsoft.
You got to get some scissors to cut this shit. Can't open it this time. I wonder what you might do.
That may be put on the back burner for now based on government security concerns is really a small issue, to be honest with you, compared to some of the bigger issues that are going on in the software space. Microsoft does own about 30% of OpenAI. We also have to consider that OpenAI's deal with Oracle is still very large, so my point is that these two behemoths, Microsoft and Oracle, are deeply tied to OpenAI. So for what's worth, I think the software narrative is putting pressure on Microsoft, as well as Oracle, as well as the rest of the group.
We have successfully recovered hundreds of millions of dollars for thousands of our clients. Even if a family member has had a specialty diploma,
It's just been a waterfall
your families to the financial complications of users. The estimated $30 billion of trust funds now available. One has been diagnosed with mesothelioma. Call 1-800-308-6528 now. Visit us at TATICAL.com.
Use Copilot. That's very low. If you look at Google, for instance, Google is making a lot of headway into custom silicon, as well as spending a lot on CapEx. Microsoft is spending a lot on CapEx, but not necessarily moving in the realm of custom silicon. CapEx for the business, $190 billion this year, 61% higher than last year, and also significantly higher than the $154 billion they estimated to spend this year. And I do think also,
this is trying to gave us the right amount.
that spending also is inclusive of a lot of component inflation, as well as, again, the agentic AI competition race is creating problems for all software names. So, like I said, irrespective of what's going on with sales and earnings, which are still robust, 16% sales growth, 22% earnings growth, profitability is a lot higher. The earnings multiple trading around 22 times next year's earnings. One would say that's fair value, but in this market, the software names are just not getting attention from institutional investors and have been selling off aggressively.
So there are some analysts who though say there's opportunity here. You mentioned, of course, that Microsoft tried to bridge that 200-day moving average. Is that what to pay attention to next? In other words, if they can claim that and continue past that in terms of the Microsoft.
Order now.
Yeah, I mean, look, short term, you know, you look at the 50-day moving average, it traded above it, you know, going back to, let's call it March, April, then it reclaimed the 200-day.
He got a break for him.
These moving averages in very quick fashion. So I think that speaks to the movement we're seeing of capital in the mega cap names from one to the next. It could be a function of
you got to kill the project.
The hardware companies or silicon companies.
You can't feel.
Intel drawing a lot of capital away. Also, the nature of agentic AI and the uncertainty around how software companies on a traditional basis are going to integrate it into their business models. Like I said, Copilot has not been successful, at least so far, and it's been very expensive for Microsoft to deploy it, and they're not getting a return on it. And what it's worth, again, unless the stock is trading above its 50-day moving average at the very least, and the slope of the 200-day moving average is moving positively, this stock is under pressure. There's no other way to put it.
All right, thank you, George. George. That's George Sill, senior markets correspondent with the breakdown on Microsoft. Those shares trading lower by about 2.5% right now. Let's get Tom and Kevin back in here for example trade purposes. So, Tom, this time you've got the example trade. What's the approach to Microsoft?
Yeah, this stock's been in the penalty box for sure. I mean, it's off 30% from those all-time highs, and they're all-time highs even if markets are at or near all-time highs. Microsoft hit an all-time high last summer, about $555 a share. So we've seen a significant pullback into bear market territory for this name. It's just struggled. Before that this week, I mean, this stock was on 7, 8 days.
You fucking goddamn chill out. He's gonna kill you because he's damn fucking out of limit.
So far, just this month alone. So I looked at a strategy. There was 4 earnings at the end of the into that. If you think it's going to rebound into those earnings while avoiding that earnings event, I've got a strategy here that gives you upside exposure as an example. I went out to the July 24th weekly options. It was expired in 37 days. And we're going to buy a bullish call vertical. Strike call.
Well, Lordy, that climbed too high and died. More with a story.
You're paying roughly, we've got 1060 debit here on it. It's trading closer to 980 now because the stock has pulled back even more from when I looked at this before. But the debit you pay is going to be a risk. So if you pay $1,060 in risk, that can expand to over $3,000 if it does go back above 415. If you pay $980 in risk. So keep that in mind. The debit you pay is going to be a risk. Now, if we pay that 1060 debit, that's your risk, but it takes your break even up to 395.65, 3% above the current share price in Microsoft. So you're giving yourself over.
Well, now, the last inventory was a 200% increase in the number of lost parts the past year. That kind of
Which is a little expensive.
Well, keep my eye out for anything.
Under $10, give yourself some duration.
I have to write you up.
I mean, if you're
That's the game.
a recovery in the software sector, then this is a chance for a triple, right? It's risk defined. You know what your risk is. It gives you upside deltas, but look at the chart on this on this stock. It is ugly. It's Microsoft, and Microsoft is probably going to figure out their path locally. Do I know? No, I don't.
This is weird. I'm not fast forward this.
Pressure, but this stock,
I don't like this kind of
if you get the move, if your direction is
This
right,
is what it evolves into. Like, when you want you fucking fake robot for your dead son, it's over. It's over. I'm going back. No redos on mine. He died, he died. Oh, I know you lying. Here it is. Now he's gonna be rolling around the house.
But giving you upside exposure, Diane, you don't
Gonna tell that me. In the last episode, there's the other robot, but the man he had him dating her. He was a full-on robot, and she got jealous of his fucking handicapped fucking little helper lady, whatever they call it, caregiver. They said, "You like to talk a little bit for me," and he didn't man and said, "Who's real?" And was fucking again.
Continues to grind higher. Investors continue to keep one eye on President Trump, who is still speaking at the G7 summit. Among the headlines coming out of that, President Trump saying U.S. only lifts Iran oil sanctions if they do things right. He says if Iran isn't behaving, they will get hit again. So a lot of pressure on and all eyes on the U.S.
Oh my God! Walking around
between the U.S. and Iran. That's going to do it for us today on Fast Market. I'm Diane King Hall, alongside Tim Hanks and Tom White. We got Next Gen Investing with Alex Coffey and Jenny Horn up next.
I'm gonna play that cat. You'll be like, you seen that cat?
So what is unique about
You don't look like this one though.
You can just see and feel all the
excitement around getting to learn a new topic.
Some of you want to get everything face to face with you and
What's
400
that?
or 500 of your closest friends. Some clients like being in the privacy of their own home on an online workshop, but still having that live interaction.
JoJo killed it.
As I'm talking,
She
questions
had
coming in
that.
from that live audience, and they help
Oh, you had to use her part.
I know it. It's home.
learn different. But all those ways we have to teach it, all from that making a difference. And so that means not just giving you theory, it means using our platform.
So we want it to be fun, we want it to be informative, and most of all, we want you to walk
got 'em rolling
away
around
with a
town?
skill set and independently be successful in achieving your goals.
But he was good. Uh-oh.
Welcome to Schwab Network, where real-time market coverage meets expert
I got it.
strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines,
There's up there.
live analysis, breaking
No, I'm
news,
not
and
gonna.
trade ideas.
He turns on the TV. He gonna start running about shit.
With speed, accuracy, and precision.
One of the most important things is you're making a play in a risk
Oh my God.
way here going into earnings.
Somebody called for you.
Further downside areas to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists. Streaming live and online.
Schwab Network, streaming 24/7, anywhere, free.
Oh no, he's anyway. He ain't. That's not him.
I do not channel.
For instant reactions, earnings breakdowns,
Oh no, what the
and
fuck
talk
is
to you
this?
about stocks and markets. Follow me on X at NPetalides and connect with me, Nicole Petalides,
Oh no.
LinkedIn,
He's learning. He's learning.
Instagram.
It's learning. Get it? Get it?
I do not fight alone.
Uh-oh, he done learned his modulator. He fucking straightened out the modulation. Oh my God. That's just the man. He's weak on it. He's not gonna see. Looks like how it already happened. How it happened.
I'm Sam Bartis, live from the New York Stock Exchange. When the market moves, we're on it. Getting the reaction, the strategy, and sentiment in real time. Stream Schwab Network at schwabnetwork.com.
They're not giving no legs. Those fucking there got all ass fucked out there. Terminators. Boy, by Terminators. They telling no because little boys get angry too. And just cry.
There's something.
Standout headlines in the sharpest cases. All right, and there we have it, our closing bell. We've got red across the board
down the
here
street because
in
it's
the
fucking calling
aftermath of
shit.
the
Doesn't know it's on the
FOMC
track.
interest rate decision.
Fucking goddamn dead daddy. And he's gonna kill the lady. He's gonna kill her. I got another Instagram.
Close out the day. The Nasdaq down almost exactly 1% at 29,760. The Dow ended the day almost 1% lower as well, 51,493, and the Russell 2K closing out the day 0.75% lower at 2918. We did see a bit more of a mixed picture right after the decision came down, but then we saw the markets really start to plummet. It also took all of our sectors along with it. We saw all the sectors close out here. Technology down by a third of a percent. Communication services a big laggard today, down 2.75%. Consumer discretionary down 2.5%. Consumer staples down 2.25%. As we keep expanding, they were going to go more red. Utilities down 1%, and the third, real estate also major laggard at 2.5%. Industrials here down more than 0.1%. Materials down 1% and a third. Don Coughlin said earlier in Trading 360 to watch real estate for volatility, and he was correct there. Financials down 0.5% here. Energy down 1.25%, and healthcare down about 1.5%, as we saw things entirely red. And let's just keep this red train going here because we've got mega cap tech entirely in the red as well. Apple down 1%. Amazon closing out the day 3.5% lower. Alphabet down 2.5%. Microsoft down almost 4%, Meta down more than 5%, and Nvidia closing out the day 1% and a third lower. Lots of red there, Alex. I often make jokes when I wear red. The markets turn red, and somehow I did it again. again, so I'd probably just take that out of my wardrobe. But let's talk about this market action and where we closed, because when we spoke at the beginning of the show, we had a mixed picture in terms of what we were seeing from our major averages. And then we saw, once the press conference ended, not a sharp decline, but a pretty swift move to the downside across the board.
Yeah, every sector lower. In terms of the areas of weakness that were most pronounced, there were the areas of weakness that were most pronounced for much of the day, and then tech joined the party. So communication services, discretionary healthcare, throughout much of the day were weak. IT swung negative, and it closing down provided 17 points worth of downside to the S&P 500, third biggest contributor after consumer discretionary and communication services, which really means Mag 7 names were a big drag. And as an index, the Mag 7 index was down almost 3%. So it's a really tough current to swim against for the overall market. Overall breadth was about as weak as we have seen in quite some time. For the first time, really since April, I would say you had a macro day today, where it wasn't a reshuffling of a portfolio to maybe take away some idiosyncratic risks of overconcentration or an expression on that front, aka a move out of infotech into something else, or move out of AI into something else. Today was kind of a indiscriminate selling of many different parts of the market, and only 14% of stocks in the S&P 500 actually closed higher. But to me, this isn't where the story really lies. Where the story lies within, unfortunately, not the most interesting topic, the Treasury yield complex. It's a very straightforward reaction, and what you saw was a dramatic flattening of the yield curve. So you saw two-year treasuries, which are oftentimes sensitive to anticipation of what the Fed may or may not do next, move up 16 basis points to 4.2%. But if you went up to the 30-year, you actually saw the 30-year come in almost 2 basis points, and they're sitting around 4.92. So net, the biggest curve that is often cited is that 10-2s curve. Well, the 10-2s curve came in 11 basis points, near over 10 basis points. That's a big move. And so what is the market saying? The market is saying, we believe that the Fed may do something in the interim to deal with inflation.
I heard like a house that turned into a second apartment.
And what that thing would be move rates higher, because the rate sensitive part of the market that is so tied to the Fed, 2-year treasuries notably, moved up 16 basis points. That's dramatic. And then when you look at the stuff that's farther out, a little bit more detached from Fed, but more associated with economic growth and inflation, it stayed the same or actually came in, which says that there's a belief that the Fed is serious and will do what they say that they're setting out to do, but also that might stifle growth a little bit. And so in a long abouts way, you may actually see kind of I don't know if a stimulative impact ultimately would happen from this, but if this was the reaction, it's saying you could actually see mortgage rates come down. And the reason I say that is the flattening of the yield curve is more of a reflection of economic concern and inflation being stifled. Had something else happen where they came out and they were very dovish and you saw short-term rates come down, you might have seen the equity rates spike, but you might have seen a dramatic move higher in 10s and 30s because the thought inflation is here to stay, it's more entrenched, sure, having more growth, but at what cost? You had almost a deflationary shockwave through the market today, and I say that word intentionally. And deflation means risk assets. That's always the I think misnomers. We talk about inflation as a risk, and it is, and it impacts us at the grocery store and at the gas pump. Risk assets. The reason the goal is 2% not 0 is some inflation is good for growth and indicative of a growing economy. If it goes the other way and you stifle it all together, you have deflationary. That was 2008, 2009. So today isn't moving us to 2008 and 2009, but it had that type of an impact where you had a deflationary wave hit this market, maybe for the first time this year, and that's not a bad thing given what has happened over the last several months, which is dramatic inflationary growth, particularly in AI.
And Alex, too, as we look at the reaction, I mean, nothing changed consequentially from when we spoke at the top of the show while Kevin Warsh was still continuing the Q&A portion of the press conference. But as I was watching the big board, we saw a pretty swift reaction once it ended. And so I was trying to refresh the Wired to make sure we hadn't missed something while we were on air here, and nothing really changed. So why do you think we saw this seesawing as everything was being announced in real time, and then when there was no consequential change, we then saw the reaction? I mean, in the markets clearly pricing in a hike by October.
I think, well, first off, the bond reaction and the hike odds changing is why you see the marketplace reacting ultimately how it has in terms of settling lower. But I think the reason that there was a back and forth was there was kind of this, I think there was probably a feeling amongst some participants like, but when are we going to get that if? Or when are we going to get that like, but I think we're probably going to see lower rates. Some sort of an asterisk, and the asterisk never came. And so when the press conference concludes and you never kind of get that bailout statement, eventually it's like this, kind of a, the water kind of breaks through and you start taking on a little bit of water onto the boat. And so, look, I think this is healthy price action. I think this is in line with the sentiment that we got. And so if your goal is, and you're Kevin Warsh, and your goal is to say what he said today, this in many ways I think is what you would have wanted to see. It's congruent with what was kind of said and I believe interpreted from the market. All that to be said, how does this jive with what was thought about this particular person and what the Fed was going to look like going in? And I think it can. And the reason I say that is one of the things we talked about earlier that he laid out was this sort of 5-part task force series about ways to, I use the phrase, modernize the Fed. I think that characterizes it well. You can't make sweeping changes in a credible way if you don't accomplish what you set out to do first. So if I'm Kevin Warsh and I want to make these changes, my first goal is get the situation under control using the old framework so I don't just destroy my credibility or confuse things before I even want to make changes so that I actually can. And so, look, he might be a little bit more dovish in terms of his lean. He may want to, really make ginormous reforms, but to do so in a credible, lasting way, he needs to solve the problem first, or at least get it into a place where it's felt that, hey, things are on track so we can comfortably make these changes.
Just tell people mistrust to consumer sell goods.
I want to touch on one of the positives. You said, I think we only saw about 14% of companies close in the green. One of those companies was Intel, and it was pretty significantly in the green with this pullback that we saw before the close on some very interesting and potentially huge developments for the company.
Yeah, so what I kind of framed this as, we talked about these details more in depth earlier, but essentially they're going through the process to test a really advanced version of their chip process, and it's a critical step towards ultimately doing this at a mass scale, and it's kind of seen as a critical step towards getting big customers like if we kind of zoom out and we look at Intel over the last decade, 9 of those 10 years has been Intel saying they were making these changes. It's going to take a little bit of time, and the market not believing it, and the stock price eroding. And then last year, they get a inflow of capital from the U.S. government, sort of a investment in terms of national security, but also, in many ways, I think it was a show of confidence seen in Intel that the U.S. government was going to be there to help them in this sort of time of need. And you saw the market change from doubting Intel to believing in Intel. But you fast forward this last year, still nothing really had changed. They still haven't signed up any of these, at least publicly, major external foundry clients. Some chatter that Google maybe has had some pretty advanced talks. Apple may be interested, Nvidia, a lot of these names, but nothing really externally public about this. Yet the stock is like 5x off of its lows. And for that all to be true, at some point these turnaround plans have to actually happen. And I think today was a meaningful step. They are not there. There is a ton of challenges still for the company. But for the first time in a long time, it's not just belief in the words, but maybe actions and meaningful progress that they can show that they're making, a couple steps down the path.
Yeah, one of those few gainers on the day for Intel, closing closing 3.5% higher at 121.10. Alex, really appreciate your continued breakdown of the reaction to the Fed announcement here, and also for a quick look at one of our top movers today in Intel. That's Alex Coffey, our senior equities contributor.
Trading at Schwab is powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform.
Hey, Pop. Hey, Andrew. Last year, my dad had a stroke. Big shock to see this person that I've always seen as force in our family be vulnerable.
Been sleep.
Had a stroke.
Been furniture around.
Now we're in the car together almost daily. I started to realize, what can I pick up from my dad? He's been with Schwab for a long time.
Jim, my financial consultant, I probably met 20 years ago.
Jim's really been there to answer any questions I ever have. Makes a huge difference when you have someone that actually cares.
I've never ever seen a website.
Real-time access, data-driven analysis from U.S. equities to global macro matters. Schwab Network connects the dots. Watch live, subscribe free at schwabnetwork.com.
Sometimes, you know, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Morning Movers brings traders the biggest headlines to start the day, from volatile overnight swings to the earliest analyst calls. Get your watch list ready. 8 a.m. Eastern, Morning Movers, only on Schwab Network.
Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
Well, now I have to go to work.
Welcome to the wrap. I'm Jenny Horn. It's time now for the Big Three. It's time for the Big Three. We've got 3 stops, 3 charts, and 3 trades. Kevin Horner joining us today to take us through the charts. Here to take us through the trades, Don Kaufman, co-founder at Theo Trade. Great to have you both with us. Don, it's Kevin Warsh's first Fed day here. Love to get your thoughts on the market action we're seeing in advance of the announcement later today.
Yeah, we should get some fairly exciting volatility, but I would look at this as a bit of a risk event, specifically for the financials, which have had a pretty staggering run to the upside lately for no apparent reason. Even, you know, Kevin Warsh is in; it's his first meeting, but look for some real volatility to hit those financials later in the day.
All right, we'll be watching. And you're not the first person who's mentioned this is a risk event, despite the fact that we're not pricing in any actual rate change today. But let's dive into the Big Three here. Talk about your first pick. You brought Humana
So you got
today.
cameras in there.
They're a little lower today, down about 1%. But, I mean, as I look at them overall year to date, they're performing better than the broader market.
Yeah, this is a staggering move inside of Humana, and you know, often you hear me say this. It's like it's a move to the upside, maybe for all the wrong reasons. So right now, we've seen some really, if you will, manic rotations into different sectors. One of those happens to be healthcare, and more specifically into Humana. We are looking though at 40% year to date. Now, look, you can make all kinds of fundamental arguments. This is clearly a technical move, but we're at the point of the technicals are getting rather exhausted in here. At a 40% move, literally straight up, technicals are getting exhausted. I think rotations are moving into healthcare and specifically Humana, as I said, as more of a defensive posturing. I would look for this, again, in just the weeks and months to come to be a great bearish opportunity, and I'm going to take advantage of exactly that. I'm going to go out to the August 21st options expiration. Again, August 21. I want to give myself a little bit of distance, a little bit of time, because I'm going to be buying an out-of-the-money put spread. I'm going to be buying a 345 put and selling a 335 put against it. So it's a full $10 wide put spread done for a $2.75 debit. I'm not asking for the world over here. I'm asking for this underlying to pull back just below 335, be profitable, move out, move on with it. Again, it looks like defensive posturing more than, if you will, real buy-side opportunity.
All right, and Kevin, as you look at this chart here, I know you brought us a longer-term one. I was looking at the full length of trading for WILE, which goes back into the 80s. Between 85, when it started trading, and all the way out through 2015, 2016, it was pretty sideways. So I'm glad that you've captured where that all changed. So you take us through what you're seeing here, and if you're seeing Don's thesis hold up, that we might be looking for a pullback.
I absolutely am, Marley. I mean, we've had on this 10-year weekly chart, I've got the 200 period, 200 week moving average in here in blue. We broke that down, and as you can see, made a huge move all the way down to the 165. And Don's right, a 40% rally into that same 200 week moving average. Remember, it was support, 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 and support until it wasn't. And now it's resistance potentially. So the setup here makes sense from Don's approach. Watching this, we've also got the rally into the 50% retracement of the entire move lower. So this is an area where it makes sense from a pause standpoint. And even if it doesn't become bearish immediately, the pause could still play to Don's trade clearly.
And as we zoom in and look more closely at this recent action, this 40% move year to date that we've been talking about, what are you seeing specifically there as we zoom in on this?
Well, a lot of what Don said validates this too. We had that huge breakthrough, major resistance at 312. 340 is our supporting moving average at this point right here. Any pullback to that is going to make this trade likely work out for the trader. So this is an opportunity that makes sense from the standpoint of what we've gotten to the upside in the short run and the possibility of the pause. When you have today's action as well, we made highs really close to 3 days in a row, and now we are dabbling with the potential to close below the low value on our highest trading day in the last week. That could be a short-term signal that some traders are looking for.
Telling us, because we just said it for the that's them telling you, hey, we're going to drop the price.
Humana trading down about 1% today at 365 and some change here. Don, your next pick is Bank of America, and they've had some momentum on their side over the last month here. I mean, up almost a little more than 15% here as I look at B of A. So how are you feeling about Bank of America? Bullish or bearish?
Yeah, no, this one's going to be bullish. It's definitely also going to be bothering me to get bullish in here, but I'm going to go with the logic that it's already cresting literally today into all-time high territory. I think it's got a little bit more juice to the upside. I want to be clear about something. Okay, in the very short duration. So clearly, Kevin Warsh and crew can change maybe some of that later in the day. But I'm actually going to be buying a slightly out-of-the-money call spread, looking for the stock to appreciate, which it did today, into literally new highs. This is a trade that we've seen so often lately. It's to me, it's less about the technicals where it's cracking into new highs. It's much more, if you will, about retail traders that are looking for stocks that are butting up against highs, and then they're jumping on and buying calls. It's actually causing these gamma squeezes to the upside. I'm going to take advantage of it. I'm going to go bullish, but I'm only going to go out to the July 2nd options expiration. It's a little shorter duration because I think the pop is going to happen.
Clients also get more flexibility in July 2nd expiration.
A 57 call.
Your plan goes with
selling a 59 call.
Anywhere you go in the country.
$20 widespread done for about a 70-cent debit. You know, Sunlight's already moved up quite substantially today. We'll see how that momentum continues through the Kevin Warsh speech today.
All right, we did touch new highs already today. We got up to 57.98. We're just barely below the 57.56 right now. So Kevin, when you look at B of A, what are you saying?
Well, as you said, we're at the top of the range here. 56 has been our highs, and here we are at 57.5 approximately. So $10 range of ballpark here. A breakout could be quite significant, but once more, when we're at resistance on the heels or in front of news announcements and FOMC, pausing up here wouldn't shock any of us, but a short-term breakout could be significant. I drew that in as well on the daily chart here. Slide over to that real quick. You can see we've had a fantastic move up since we took out the downtrend line, and I think traders traders tend to watch these key levels. When you move through the downtrend line, it shouldn't be a shock to get a little bit of an explosive move. We got exactly that right into 57.50. So, you know, any clearance on a closing basis over 57.50 is going to look pretty bullish in the near term.
Yeah, right now we're above that. We're at 57.63. We are up 1.33% for B of A right now, which will bring us to your last pick in the big three, Don. Microsoft here has been under some pressure, again today as well, too. We're down about 2%. Year to date, down about 20%. So how are you feeling about Microsoft?
Not good. This is really bearish. But, you know, I'm just going to throw this out here. You have some of what I would term like the tech titans. You want to call them the monsters of tech, the tech titans, including Apple, Microsoft. Now, Microsoft at least has investment in AI. It doesn't even have that, and yet it's still continuing to appreciate. But you have some real players right now in the game that really do not have, if you will, great and positive exposure to AI, Microsoft being one of them. And it's got considerable exposure, of course, to software, which there's been a very much a love to hate relationship with software-based stocks recently. They got a bid back under them, but I got to tell you right now, taking a look at like the CRMs and the SAPs and Microsoft, they're getting hit and hit hard again. Again, with all due respect, I think you're going to see Microsoft have to crest again through new lows, and that new low, you're looking at 356 as the one of the recent lows. I think we're actually going to crest through that, and again, it's going to be done on some fairly strong momentum to the downside. There's just not a lot of love right now in this marketplace for Microsoft. So I'm going to go out to the July 17th options expiration. I don't think I have to go very far out in here because it looks like it's, you know, we're ready to go. We're ready to break at this moment. I'm going to be buying again a 380 put and selling a 370 put against it. So that's the position, right? So I need that product to get below 380. So why am I selling the 370 put against it? To mitigate some of the volatility exposure, to mitigate that expense, if you will, of the 380 puts. I love to use spreads to control risk over here and define my risk. In the case of this trade, my risk is $2.75. That's it. Upside potential, just over $7. I mean, it's a nice risk reward. And what am I asking to have happen? Again, the stock needs to get below 370. But as I said a moment ago, I think we have to retest that 356 low and then some. Again, some of the tech titans, it's just not there. It's you know, is Azure going to save them at this point? Possibly not. And I think that people see that fundamental future for this underlying.
And Kevin, as you look at this chart here, we're at 380, 584 right now. Are you seeing the potential to retest those lows around 356?
Yeah, I sure am. I mean, this is an interesting chart to me for a number of reasons. The levels that Don called out certainly work with the technicals as well. The last low we saw back here, you know, clearly on the level here. But the other thing that's very interesting, this will maybe throw a little cold water on Don's bearish thesis perhaps, is just the idea that we have been